Okay. Now we are going to discuss economic growth. The objective of this topic is to understand the components of GDP and GDP growth rate. Remember the GDP equation? GDP is C plus I plus G plus X minus M. C is consumption, I investment, G is government spending, and X minus M is exports minus imports. Correct? So we are going to understand what are the factors that cause the growth rate in GDP. Okay. Economists measure the economic output of a country by GDP. Correct. But, you know, highest GDP country, can you name me top five highest GDP countries in the world? Yes, yes, yes. Everyone. Number one, USA. Number two, China. Number three, yes, you have UK, India, France. Okay, these are the top five Germany, sorry. These are the top five countries GDP wise. Now, even though India might be amongst the top five in terms of GDP, or even China, top two, but not necessarily they are developed countries. Why? Because GDP as a total is not the correct measure of the development of the economy or the standard of living. So for the standard of living, we use a term called GDP per capita. Correct? We use GDP per capita. And per capita GDP wise, you have Luxembourg, Qatar, Switzerland, US. US has also high per capita GDP, right? So on per capita GDP, basically that means the standard of living, right? Historically, there have been large variations in both GDP growth rates and per capita GDP. Yes, we are concerned with the growth rate in GDP, right? And the per capita GDP, but they are saying there is a large deviation. Research has identified several factors that influence both. When I say both means the GDP growth rate and the level or the per capita GDP. Now, there are several factors. Out of that, we are going to understand the six factors which affect the most. When I say most, to what? The GDP growth rate. Okay. These six factors you don't have to memorize. I'll just discuss savings and investments. First of all, savings and investment. High saving will lead to high investments. So they are positively correlated with the economic development, right? No need to go in detail about that. When I say savings, it means basically the savings by the individuals that will transform into more investments. Correct. For countries to grow, private and public sector investment must provide sufficient level of capital per worker. So there should be enough capital per worker. We'll talk in more detail about capital per labor or capital per worker. This is going to become a very important discussion point coming up, right? Those countries which do not have enough capital, of course, they have to open their doors for foreign capital. So they have to let foreign capital come in. Those who have insufficient savings, correct? So that is all about savings and investments, how they affect the economic growth rate in a positive way. Financial market intermediaries means banks, mutual funds, insurance companies, right? They help us allocate the resources. Number one. First, financial markets determine which potential users of capital offers the best return. So the best return gets the capital, correct? But on a risk adjusted basis. So high risk, high return, that structure is done through the banking and the mutual fund section, right? Financial instruments are created by intermediaries that provide liquidity and opportunities for risk reduction, like hedging. Correct? Financial markets help you to hedge or they provide you liquidity by selling it on the exchange. And many mutual funds, they collect money from very small investors. They pool the small amount of savings from various investors and then they lend it or they give it to those who require that or invest in risky projects. So the role of intermediaries is very important. Okay. However, some caution in order. However, financial sector intermediation may lead to declining credit standard and increase in leverage also. So many of these financial, this intermediaries, they can create asset bubble. They can, increase the leverage in the economy, like and create housing sector crisis, like what we saw in US. The third factor which causes the GDP growth rate is the political stability, rule of law, and property rights. Countries which have high protection of property rights, when I say property, means both physical and intellectual property, right? Those countries, as well as those countries which are not affected by wars or corruption, they will have high growth rate in GDP. Countries which invest in human capital, yes, human capital means the skill and well-being of the workforce. For those who do not know me in depth, I have been privileged to support the UAE government, the Abu Dhabi government, in helping the local candidates train in various financial programs like CFA and all. So I am one of the very few, I mean, I can share this with my uh, classmates openly, right? I don't want to brag it outside, but I'm very few professors who are directly, and my company is directly, in association with many of the government companies in UAE, and I help them train in financial programs. So this is very rare. This is not possible for a person who is an individual. Not, I don't run a big company, but just because of the hard work and talent is what I've got this opportunity, not because of any reference, not because of any of my connections, but purely because of the hard work. And this is possible in, can you imagine, in the world's most most richest city, this is what is possible, that an amateur and an outsider, an expat, comes here, starts his company and gets an opportunity. This is possible for me in the last 5 years, and I'm very privileged. What I'm trying to tell you is that the government has the emphasis here to make the people skilled, highly skilled. And this is where, we come up. So many governments, I in fact spoke to many of our students here in the batch from Africa, and they told me that their government is also giving incentive for people to study CFA. So this is a remarkable thing. So when government invests in skill and development of people, that is where human capital will grow. Okay. Countries that invest in education and healthcare system tend to have higher growth rates. I've actually made a YouTube video on this, that how Germany or South Korea or Taiwan, how they revived themselves after the Second World War, where they were completely downtrodden, they were completely in mess and in poverty, how they uplifted themselves and how education played a very important role. Okay. Less developed countries benefit the most from spending on primary and secondary education, because like countries like India and all, we all have a huge drop from the school. So investing heavily in primary and secondary education is more important for less developed countries compared to highly developed countries where skill and tech becomes very important. Tax and regulatory system must be favorable for economies to develop, and many of my Indian students will agree that this is one problem that is dragging the country. Lower the tax and regulatory burden, higher the rate of economic growth rate. See, people are not worried by paying high tax. They are more worried about the stress that comes with tax, the compliance burden. Okay, that is what people want, to make it easy. They won't expect government to make it easy. Low levels of regulation foster entrepreneurial activity. So low interference by the government will make it easy for us to conduct the business. Okay. Free trade and unrestricted capital flows. Yes, if there are no trade barriers, that will result into positive economic growth. Understood? Especially those which are in the export industry, they will really benefit. Unrestricted capital flows mitigate the problem of, as I just discussed, insufficient domestic savings that can be coped up by foreign investments, right? Foreign capital can come in the form of two ways. They can invest in physical property or plant and equipment, which is what we call FDI, foreign direct investment, or foreign financial investment. Foreign financial investment is when they invest in financial assets like stock and bonds, which is also called foreign institutional investment by many. But foreign financial investment is when foreign companies only invest in your equity and bonds. But when they physically set up their offices and branches or franchises and conduct the business here or conduct their plant operations here, that's called foreign direct investments, right? All of these factors will lead to high economic growth. Easy? Okay. So now, remember in equity, we did sustainable economic growth rate means in the long run, the growth rate of economy is what we consider as a sustainable long-term growth rate. Remember the normal growth rate. So whenever we are investing in equities, we do project that for the next 5 years or 7 years, the company will grow at a super normal growth rate. But at some point of time, the growth rate in the economy will be constant, equivalent to the economic growth rate. So prices are positively related to earnings growth. Economy-wide aggregate corporate earnings can grow if the GDP grows or if the share of corporate earnings in GDP grows. Means yes, if in the GDP, majority of the share is from the corporate profits, and if the GDP grows, the overall equity market will benefit. So overall economy will benefit. Sorry, the economy will benefit if the corporate profits or earnings grow and their share in the GDP is higher, isn't it? Rather than any other agricultural or other sector, more from the corporate profits and their share increase, that will lead to higher economic growth rate. Now, however, the share of corporate profits in the GDP cannot increase indefinitely because labor will be unwilling to work for a low and lower proportion of GDP. Yes, see, corporate profits cannot grow forever because at some point of time, the labor or wage rate will start increasing. Understood? And that will lead to the higher revenue, higher output, but less profits. Okay. Therefore, potential GDP, the term that we are going to use again and again, what is potential GDP? The upper limit of real growth rate of the economy. So this is the growth rate of the economy, the maximum growth rate or the sustainable growth rate of the economy. That is called the potential GDP. Remember, potential GDP is the maximum limit, the upper limit of real growth rate. That is the long run limit of earnings growth rate. Yes, in the long run, what is the sustainable growth rate? That is called potential GDP. Potential GDP, I'll again repeat, it's the long run sustainable growth rate. Okay, which is going to be the real upper limit. Anything beyond that is not sustainable. Anything below that has more capacity to increase. So this is sustainable. Potential GDP is a sustainable long run economic growth rate. And when I say growth rate, we always talk about real growth rate. We don't talk about nominal growth rate because when we are investing in a country, we are looking at the real growth rate. Okay. Now, this long run growth rate in the GDP is used to derive the expected returns on equity. Remember, expected return on equity, we've used several models in equity called the CAPM model, multi-factor model, Pharma French model. Now we will use the growth rate in the economy to predict the equity's expected return. And the model that we are going to use is called the Grinold-Kroner model. A very, very famous model from your exam point of view also. Now, what is this model? It tells me, it gives me what is the expected return on equity. Now, guys, what are the two components that you get from equity? Can you give me in the chat box? What are the two components of returns that you get from equity? Please, please, please. When you invest in equity, what are the two ways to get returns? Income and capital appreciation, which means dividend and capital gains. Am I correct? The two ways of getting returns in equity, dividend and capital gains. So expected return on equity is nothing but the dividend yield and the expected capital gains yield. Yield means returns. So total returns from equity naturally comes from two components, dividend yield and expected capital gains yield. Now they have decomposed all of that. For example, expected capital gains yield is decomposed into EPS growth and expected pricing. Then EPS growth is also decomposed into real inflation and changes in shares outstanding. And then this changing in shares is further decomposed into this NBB, which is net stock buyback plus relative dynamism. All of that is the decomposition of the Grinold-Kroner model. Now, what I will do is that I will do the decomposition right in front of you, and you can copy with me. It is very interesting. So I'll make just a flow chart for your reference, and then we'll go to the component and discuss. First of all, we are using the Grinold-Kroner model for understanding the equity expected return, which is a combination of two things. Yes, dividend yield, dividend yield If you notice here, what is the exact word that we use here? We use dividend yield and expected capital gains yield. Expected capital gains yield. So I will use expected capital gains yield, right? This dividend yield, we will write a short form DY, and expected capital gains yield, we can use CGY. CGY is capital gains yield expected. Okay, futuristic, right? Now, together, that will give me my expected returns on equity. Of this, what are we going to do? We are going to decompose the dividend yield is simple. It is the dividend over the price, correct? Capital gains yield is based on the future growth rate of the economy. Okay. So we are going to first decompose the capital gains yield into what are the decomposition of that. We will now understand what is expected capital gains yield. See, check here. Expected capital gains yield. How does the company's price will increase? That is dependent on EPS growth rate and P. Remember, P into EPS is price, right? P into EPS is price. I'll repeat. Price earnings into earnings is what we get as price, change in price. So expected or EPS growth or change in EPS and change in P. Change in P is called expected repricing. So in our formula, expected capital gains yield is made up of two things. That is EPS growth rate, EPS growth, which is what we call as change in EPS, and change in the PE ratio is called expected repricing. So we use a term called expected repricing. Repricing, why? Because when the PEs change, the pricing will change. So these two are the breakdown or decomposition of capital gains yield. But when I say EPS growth rate, expected EPS growth rate, now under that also we will decompose what is my expected change in EPS or EPS growth rate. So what is EPS growth rate? It can be decomposed. EPS growth rate, by the way, is a nominal term. So nominal term can be decomposed into real EPS growth rate plus inflation. Real EPS growth rate plus inflation. So when I say EPS growth rate, this is basically, for my reference, I will write it is nominal. Now I need to break down into real and inflation. We know the Fisher effect, real and inflation. So we will say this nominal growth rate is real EPC growth rate, real EPS growth rate. So I will write down real EPS growth rate, and we write inflation. So we have real EPS growth rate and inflation. These two things. Of course, there is a third component also, but just utilizing the term that we use here for real EPS growth rate, change in EPS real. So this is what I can write, change in EPS nominal. And here I will write change in EPS real. And for inflation, they've used a sign of pi, which is what you can just use for our reference. So these two, plus there is one more component. See, the company's earnings will also be higher if there is a difference in the share. So if the difference in the share number of shares outstanding, now this is minus change in S. What is this? I will discuss. So minus changes in the shares outstanding. So minus changes in the shares outstanding. Changes in the shares outstanding. All of this component I will discuss one by one. So this is minus change in S. And then this change in S is also further decomposed. This change in S is decomposed. So I will focus on this change in S is decomposed into two parts. What are the two parts? First, I will write down that is net stock buyback and relative dynamism. So I will write net stock buyback, net stock buyback, and we use a term called relative dynamism. Now this is NBB and relative dynamism. Between both, we add it. Okay. So now check one by one all the components. These two, we just added. Okay. So see, it might look like a mess, but see, expected return on equity using the growth rate of the economy. Okay, it is made up of two things, dividend yield and expected capital gains yield. Expected capital yields, I further decomposed into two components, EPS growth rate and expected repricing. EPS growth rate and expected repricing. EPS growth rate, expected. But EPS growth rate is nominal, that is change in EPS. So we break down into real growth rate plus inflation and changes in shares outstanding, which we will discuss in a moment. What is change in S? Change in S is further decomposed into net stock buyback plus the relative dynamism. Everyone understood first the flow, right? And then I will discuss one by one all. Okay, this is what it is. Yes, clear? Okay, you can write down this. This will really make it easier for you. And now I'll discuss all. Okay, see this. Now, first of all, EPS, company's EPS will grow, but that's a nominal, which is equal to real plus inflation, correct? That is easy. But what is change in shares outstanding? Now, guys, changes in shares outstanding. Do you remember when the company will buy back the shares, the number of shares will increase or decrease? When the company does buyback, the number of shares will, yes. The number of shares will decrease. So earnings per share will increase. The earnings per share will increase, isn't it? So the change in S, the dilution effect, it is called the dilution effect, sometimes play a role in determining equity return, but its impact differ by country depending on the level of development and sophistication. Now, all this you don't have to go in detail. Just remember that on an aggregate basis, the dilution effect is comprised of net stock buyback. Now, see, guys, if the buyback is high, when I say net stock buyback, as well as issuance by privately held small and medium entrepreneurial companies. What does it mean? So here, net buyback is when the new issuance minus buyback. So net buyback, it would be more, see here, it would be actually more appropriate to call NBB net issuance, where net issuance is new issuance minus buyback. So I'll write new issuance minus buybacks. So guys, tell me if the company issues more shares. If the company issues more shares, if I issue more shares, then the change in S will be positive. The change in S will go up. If more shares are issued, earnings per share will go down. See, therefore it's negative. But if there is more buyback, change in S will fall or negative. Then the negative becomes positive and the EPS growth will increase. So again, I'll write down the EPS growth will increase if what happens, the issuance is less than buyback. Issuance is less than buyback, or the buyback is more, or I can say when the change in S is negative. Change in S is negative means number of shares are not increasing but decreasing. If that is happening, that will happen because of buyback, then the EPS growth will be higher because per share earnings will be high. Are you getting this point? What is NBB? What is NBB? RD I will explain. RD I will explain. What is RD? So see, RD, we call the role of the small and medium entrepreneurial companies, the relative dynamism of the company. It captures the difference between the overall economic growth and the growth of the listed company. So see, when the economy is growing at 5 or 6%, not every company is growing at 5 or 6. Some are growing at less, some are growing at more. So the companies which are expected to grow more than the economic growth rate, that extra growth rate is called relative dynamism. So if some companies are expected to grow at a very high rate, the RD is positive. Relative dynamism, it's a difference between the overall economic growth rate and the earnings growth rate of the company. I'll repeat, that's called relative dynamism. Why? Because some companies will grow at a higher rate than the economy and some companies will grow at a lower rate than the economy. So that difference is called relative dynamism. Understood, everyone? So check one by one. Earnings, what is the expected return on the equity is dividend yield and capital gains yield. Capital gains yield we break down into EPS and change in EPS and change in PE, pricing. Change in EPS is nominal, so we break down into real, inflation, like a Fisher effect, and change in S, change in shares outstanding. So there will be more shares that will reduce the EPS, and that will happen if the issuance is more. But there will be negative shares, or that will happen when there is a buyback. So negative becomes positive. So the EPS will grow if there is more buyback. Got it? Now, therefore, the change in S is composed of two things: net buyback, which is issuance minus buyback. I can write it down. Net buyback is what? It is issuance minus buyback. Okay, that is issuance minus buyback. And relative dynamism is the difference in the growth rate of economy and the difference between the growth rate of economic growth rate and the growth rate of small and medium enterprise. So I will write down this RD is relative dynamism. It's the difference in growth rate, difference in growth rate of economy versus the small and medium enterprise versus the SMEs. Okay. Now, of course, you don't have to go in detail about all of this components. Just basic formula you need to remember. Okay. Now, this is the way they have broken down the overall equity returns or expected returns on the equity. So three breakdown you need to remember. Expected capital gains yield, that breakdown you need to remember. Change in EPS breakdown you need to remember. And change in S, this breakdown you need to remember. Got it, everyone? This is the Grinold-Kroner model of economic growth rate. So how the economy's growth rate translates into equity returns, that comparison is by the Grinold-Kroner model. Now, in this model, one thing I want to mention is that amongst all the components, the dividend yield is expected to be stable. Companies generally don't deviate too much of their dividend policy. So dividend yield is expected to be stable, and the repricing change in P does not fluctuate, does fluctuate with the business cycle. Sorry. So P ratios, they fluctuate with the business cycle. At the peak of the business cycle, the prices are high. At the bottom of the cycle, the prices are low. So when the GDP growth rate is high, market multiples rise. The repricing cannot, however, continue to grow. Therefore, in the long run, the key factor driving the equity returns is change in EPS. So, guys, in the long run, they are saying that, of course, the dividend yield is stable and change in PE, this cannot grow forever. This cannot grow forever. So in the long run, even this will saturate. So now, if you notice, the growth in the expected returns from the equity are dependent on the EPS growth rate. So the key factor driving the equity returns is the change in EPS. And when I say change means the real, that's what I'm more interested. Correct? Which itself is subject to upper limit of potential GDP growth rate. This is what we just discussed. What did we discuss? That the economy cannot forever grow at a high rate. So potential GDP is what is potential GDP? We just discussed potential GDP, the term is the upper limit of real growth rate. This upper limit. Why? Because beyond a point, if the economy is growing, the labor or the wage rate will, the labor cost or the wage rate will also grow. So no economy can forever grow at a high rate. So that potential GDP rate is the maximum real growth rate. Got it? Everyone, right? This is the discussion about the Grinold-Kroner model. Okay. Now, explain why potential GDP and its growth rate matter for equity and fixed income investors. So we are going to discuss why this potential GDP or the upper limit of real growth rate is important for evaluating equity and bonds. First of all else equal, higher GDP growth rate will definitely give me higher equity returns. And in fact, bond returns are fixed. But equity growth rates, higher the growth rate, higher will be the equity returns, correct? But we discussed the change in S. So equity returns are significantly affected by dilution. Dilution can happen due to buyback, due to mergers and acquisition, where you're giving shares to the target company or giving ESOPs. All of these will lead to dilution, right? Economic growth rate can also be attributed to privately held companies. Potential GDP has the implication for real interest rates. Positive growth in potential GDP indicates the future. All of this, what is the conclusion? That whenever the potential GDP will rise, the economic growth rate will increase. Of course, the equity returns will also be high. But when I say potential GDP, I am focusing on real growth rate and real interest rates. Okay, so positive positive growth rate in GDP will lead to more interest rate or less interest rate. Well, that will lead to high future income, and high future income. So your current income might be fixed, but the future income will be high. So whenever the future income is high, tell me one thing: will you spend more or save more? If you are expected to have a huge increase in your salary, won't you start spending already more or less? So see what happens when consumers expect their incomes to rise, they increase the current consumption and save less for future, because they know that will be compensated by future high growth in earnings, right? Everyone in the class, right? So see, again, I'll repeat, whenever you are expected to have high earnings growth, or I am expecting my salary to increase, I will start consuming more right now because I'm less worried about the future because my income will increase. Okay, so consumers behave in this manner, right? What is the purpose of this? The conclusion of this is that they are less likely to worry about the future. Okay, so to encourage consumers to delay consumption so that they save, I will have to have high interest rate or low interest rates. Well, I will have to give higher interest rate as an incentive for them to save. So whenever the GDP, the potential GDP or the real GDP is expected to rise, naturally the interest rates will also increase, or have to be increased. Otherwise, people will have more incentive to spend than save. So the conclusion is that therefore higher potential GDP growth rate implies higher real interest rates and higher real asset returns. Because all of this, when the interest rate is high, we know when the interest rates will be high, that will lead to higher EPS growth rate. Clear? When the real, I'm talking about the real interest rates. Okay. So what did we understood? That higher GDP will translate into higher returns for equity. Correct? In short term, the relation between actual GDP and potential GDP may provide insight to both equity and fixed returns. See, actual GDP might be low or high than the potential GDP, but in the long run, potential GDP is where you are having a GDP at the maximum employment. Maximum employment does not mean 100% employment. Okay, 100% not everyone gets job in the economy. So potential GDP is the rate at which there is full employment. Just to recollect from level 1, potential GDP is the GDP at full employment. But guys, when I say full employment, does not mean 100% employment. Okay, every economy has some unemployment. That some minimum unemployment should be there, otherwise there will be high inflation. Today Canada is facing such a high inflation because its unemployment was very low, and that's why it wanted immigrants to come up and fill up the jobs. But now there is a huge influx of immigrants and the economy is not doing that great. So that is backfiring Canada. Understood? Got it? And of course, there are various other reasons also. But I'm just saying one of the reasons, how it is connected to the syllabus. For example, since the actual GDP in excess of potential GDP results in rising prices, as I said, if the economy is more than the potential GDP, that happens when everyone is getting more jobs, the economy is thriving more than the potential GDP, it's not sustainable. It will lead to high price rises, high inflation. The gap between the two can be used to forecast inflationary pressure, as I just said in the case of Canada. Now, I know when the inflations are too high, who is going to suffer as an investor? Fixed income. If you are invested in a fixed income security which is not inflation protected, then you will suffer. If you are invested in an inflation index bond, you will make more money. So every, connection, you can see the connection of the GDP, the potential GDP with actual GDP, how that translates into the returns of equity and bonds. Okay. Furthermore, the central banks will adopt monetary policies to cool down the inflation, and they will do what? They will raise the interest rates, and when interest rates are high, fixed income returns suffer. Okay. So when actual GDP growth rate is higher than potential GDP, what should the central banks do? They are more worried about inflation, isn't it? Correct. And therefore, they will increase the interest rates or decrease the interest rates. Well, they will be more restricted. They will increase the interest rate, right? So see, what will they do? When that happens, the concerns of inflation increase and the central banks are likely to be more restrictive. That means they will, this is what will happen when the actual GDP is greater than the potential GDP. When this case happens, the interest rates, the central bank will definitely increase the interest rates. So this is the effect of monetary policy, you can say, on the GDP, the monetary policy's action on the fixed income and equity. Both will suffer, correct? What about the fiscal policy? Remember, fiscal policy is all about taxes and spending. In addition to predicting monetary policy, the relation between the actual and potential GDP can be useful in analyzing fiscal policies. So how actual and potential GDP will help us understand what fiscal action the government will take. It is more likely for a government to run a fiscal deficit when actual GDP growth rate is lower than potential. Yes. So government will have a huge fiscal deficit when the actual GDP is below the potential GDP. So government will have to provide tax incentives, spend more into the economy to boost the economy, and that will lead to high fiscal deficit. Okay. So we will get to know what is going to be the fiscal effect due to the comparison of potential GDP with actual GDP. And that will also tell us that if the government is running at a fiscal deficit, don't you think so? They will do one thing to fund that. That is that they will do more borrowings, isn't it? So finally, because of the credit risk assumed by fixed income investors, growth in GDP may be used to gauge the credit risk of both corporate and government debt. Means economic growth rate of GDP will help us analyze how the bonds will behave, right? For example, a higher potential GDP growth rate reduces the credit risk because government will have to borrow less, isn't it? And increase the credit quality of all debt issues. Yes. So if the actual GDP is greater than the potential GDP, the credit risk improves. So the credit risk is on a positive side. So that will be positive for all kinds of debt, government and corporate debt. This will be the case when actual GDP is higher than potential GDP. So the only drawback of actual GDP higher than potential GDP is interest rates will be high, but the fiscal deficit will be low if the actual GDP is higher than potential GDP, and that will reduce the debt risk, or the credit risk will go down if the actual GDP is greater than potential GDP. Got it? We'll do some questions regarding to Grinold and Kroner models, and we will see how that is going to be appearing in the exam. Let us see if we can do something from the case study point of view. Everyone? Yes. So let me see the question. Economic growth rate. Okay. Allowing. Okay. And based on the comments, what would be the likely forecast of long-term aggregate stock market appreciation? So these two things we are going to see if we can, and based on firms recording. Okay. restrictive, whether it's a fiscal policy restrictive or not, we can try this also. Cobb-Douglas, we haven't reached Cobb-Douglas. Okay, let us see that. Number one, the first question is, which of the following action by Minicas's government is most likely to increase its economic growth rate? So we have to look at which action from the government will increase its economic growth rate. First of all, we don't need to go to the case study. We can directly see the choices first. Increasing protection for consumers. Guys, protection. Economy is more protective. Will that increase the GDP? More trade barriers will reduce the GDP. It will not increase the GDP, right? Allowing foreign institutional to enter the market. Yes. When you are allowing foreign capital to enter, that will increase the GDP. Am I correct? Right? So this is probably the answer. Let us look at the C. Expanding public domain legal legislation. Public domain legislation means what? Increasing, making more laws. In such a case, the economy will become, it will not grow. So what will lead to more growth? When I'm having less control and more free movement of capital, that will lead to more growth. Got it? Right? By allowing free movement of capital, that will lead to higher growth rate. Based on the Commerce Department report, yes, do I have any question here? No. Okay, yes, B. Based on the Commerce Department report, we'll read what it is. What would be the most likely forecast for long-term aggregate stock market appreciation? Now, we have this, we will read this. Jay Smith, an analyst with Mako, is evaluating investment prospects in mini cars and emerging market economy, developing economy. Minicas has experienced moderate growth in the past 4 years, and after decades of stagnation, Smith is evaluating changes in government policies that would foster high level of growth. So proposed changes, we have consumer protection will be at the forefront. So this will not be, we discussed already. The government will lower the entry barriers for financial institution good. The government will expand public domain legalization to acquire private company. No, nationalization is not positive for the economic growth. Smith reviews a report published by Minica's government. The report indicates that the long-term real growth rate of GDP is 2.5. Corporate's profit as a percentage of GDP increased by 2% in the last years, and the P ratio increased from 17 to 19. This is very important. This is where I will get the long-term growth rate. Smith also reviews World Bank reports indicating Minica's potential GDP growth rate. Okay, this is what we'll discuss later. This is not important. Okay, all of this. Okay, that is what we are going to study later. Now, they have asked me, based on Commerce Department report, what would be the most likely forecast for long-term aggregate stock market appreciation? So this is what the information is. The year is the information. So long-term real growth rate is 2.5 of the GDP. Corporate's profit as a percentage of GDP increased by 2% last year, and PE ratio increased from 17 to 19. Remember, when I say long-term growth rate in stock market is a function of what? GDP growth rate. So that is based on GDP growth rate. And when I say GDP growth rate, the real GDP growth rate. Correct? But the other factors, the other two factors here, they have given me corporate profit as a percentage of GDP increased by 2%. And the P ratio also increased from 17 to 90. Okay. Now, what do we need to understand? That in the long run, when I say long run economic growth rate, these two factors, the other factors, the dividend yield, which is stable, the corporate, or when I say the change in P ratio, they cannot forever keep on high, right? They will not be sustainable. So they will not impact the long-term growth in stock market. Whenever they say what will impact the long-term aggregate stock market, it is only the long-term growth rate in the real GDP. So whenever they say this, the reason I've put up this question is that we use the expected returns formula. They have not asked you to find the Grinold-Kroner model. Just the reason that I took this question, of course, it's there, but the reason I took is to explain you that when they say long-term aggregate stock market appreciation, you will only focus on long-term economic or GDP growth rate. When they say long-term economic or GDP growth rate, only that is your focus All others are not sustainable. So here, out of everything, we will only take 2.5 percentage. Corporate profit as a percentage of GDP or change in PE, they are not sustainable. They are not going to be forever. So only the long-term real growth rate of GDP is what we take, and therefore the answer will be 2.5 only. Okay, this is something that I just wanted to connect what we learned as theory in terms of questions. So whenever they say what is a long-term aggregate stock market return, if they give you the components of Grinold-Kroner model, great. If not, you only have to focus on long-term economic growth rate or long-term GDP growth rate, nothing else, correct? Because everything else is not sustainable. The rest of the questions we will do later when we proceed through the syllabus. Okay, everyone. So this Grinold-Kroner model might be tested up in exam. It has a high chance of being tested in exam. Now, we focused on how economic growth rate will lead to equity growth rate. However, now we will focus on the different ways through which economic growth rate will increase. So now we will focus more on the GDP growth rate only. So our focus will be on the factors that increase the economic growth rate, means the GDP growth rate. Okay. Now there are various factors, and these factors are called factors of production. Remember the factors of production: land, labor, capital, technology, entrepreneurship, right? Now, there are various factors which affect the economic growth rate. Of that, we are going to focus on two factors, that is labor and capital. Labor, L, capital K. I'll repeat, out of many factors, our focus on the economic growth rate is on two factors. And when I say aggregate production of output means GDP. So here Y means output. I'll repeat, Y is output, which is nothing but the GDP, or they say aggregate production or aggregate demand, whatever term that they use, that's called Y, which is a function of labor and capital. Labor and capital, but there is very important the third component, that is technology. So Y, that is output, is a function of three things: technology, labor, and capital. Technology, labor, and capital, but labor and capital are in some proportion. That proportion is called alpha for capital and 1 minus alpha for labor. So alpha is for capital and 1 minus alpha is labor. What is this alpha and 1 minus alpha? It is the share of output which is due to or allocated to capital or labor. So basically, share of output allocated to capital, the proportion of, you can say, capital's contribution in the GDP, that is alpha, and labor's contribution in the GDP, or how much the change in labor will grow the GDP or increase the GDP, that is 1 minus alpha. Okay, so share of output allocated to capital and labor, also referred to as capital and labor's share of total factor cost, where alpha is going to be less than 1. Okay, so guys, not everything is coming from capital and labor. Okay, there is a third component which is very important, is technology. So there are going to be various formulas based on this. The T, technology, represents, why is it called T? It's called total factor productivity. This is something which does not come from labor and capital. That is called T, the component which is due to technological progress. Now, of course, you might have an argument that technology also comes due to labor and capital, right? Yes, no issues. We'll discuss that also. So this model, which is a function of the GDP, is the function of three things: technology, capital, and labor. This model is called Cobb-Douglas production function. Now, you will see various formulas related to it. I'll mark all of them. One of the formula we did was this. So I will mark this as F1. I consider this as only one formula. The rest are component of it. Now we are discussing the Cobb-Douglas production function. Now the main formula for your understanding is this, but for application, we will use a different formula. So the main formula of Cobb-Douglas production function is this: Y, that is the GDP or the output, which is a combination of three things: labor, capital, and technology. The proportion of labor and capital in the GDP is alpha and 1 minus alpha. Capital is alpha, labor is 1 minus alpha, right? The Cobb-Douglas function essentially states that output or GDP is a function of three things, as I said, labor and capital and their productivity, which is technology. It exhibits constant returns to scale, increasing both inputs by fixed percentage leads to same percentage increase in output. What does it mean? That if I increase the labor or capital by 5%, my output will also increase by the same rate. That's why it's called constant returns to scale. So Cobb-Douglas function is based on the constant returns to scale model. So when I divide the model by L, both the sides by L, this becomes output per labor. Output per labor is like GDP per capita. Remember GDP divided by the population? That is GDP per capita. So here when I say output per labor, output divide by labor, and on the right side, the equation that I had T into K into L alpha and 1 minus alpha. What if I divide that by L? So L gets cancelled. Then you are only left with T and K. That is T times capital per labor. Capital per labor. So output per labor is T into capital per labor. And for capital, I will do alpha. Why? Because the labor over labor will become 1. When I divide by labor, labor over labor won't exist, right? Everyone? Now, these two formulas are perhaps the same thing. I'm just writing them differently. One is the total output and the second is output per labor. Okay. So what is total output and output per labor? It's like GDP and GDP per capita. Same. So see what I write here, and this is how you can remember. By the way, we are doing Cobb-Douglas production function. All of this comes under Cobb-Douglas production function. Okay. Now, before I start the production function, when I say Y equals to output, or simply said GDP, you can say it's simply the GDP. But when I say Y over L, that is output per labor, output or GDP per capita. So I can say output per labor, or you can say GDP per capita. Same like the, GDP per capita is output per labor. So when I say Y, it's total output. Y divided by L is output per labor. Understood, everyone? These two terms. Now there are two functions that you saw. You saw one based on output, the one which was based on output, and the one which was based on output per labor. So this is based on Y. This is Y divided by L. Correct? So this model is T, L, and K. Labor and capital. T, L, and K. To be precise enough, it's actually T first, K first, and L. Why? Because K is alpha, L is 1 minus alpha. So this is the model. But for exam, we don't use this model. Okay, I'll show you what do we use for exam calculation. This is my model for total output. Total output is not more important as much as output per labor is. So what is output per labor or GDP per capita? Under that model, we are only left with T and capital per labor to the power alpha. So T into capital per labor. This is output per worker. These two things you need to remember under the Cobb-Douglas as of now. Now I'll discuss everything one by one. Okay. So labor productivity is similar to GDP per capita. It measures a standard of living. So see, your economy growing is great. The total GDP is growing is fine, but GDP per capita should increase. That is called efficiency, isn't it? So when the output is increasing, but not just by increasing more labor, but by using the same labor and more technology, the output can also increase. Or by putting more capital, the output can also increase. So by having the same amount of people, let's say Germany has same population and another country has same population, which is a less developed country. But Germany uses more capital and technology, or uses rather more efficiently. then its GDP will grow at a much higher rate than the other countries, isn't it? Correct? So not two countries having same population are growing at a higher rate, isn't it? That is why, because it's not about the labor, it's about the quality of the labor, it's about the efficiency of the labor. That is what is output per worker. That is more important. Okay. The previous equation has important implication about the effect of capital on the standard of living. First, we will discuss what is the effect of capital on the GDP growth rate. As I said, just by increasing the labor, your GDP might grow, but not grow at a higher rate. You cannot increase the labor all of a sudden by just making the immigration free. That is not sustainable. So output per worker should increase, and that can happen due to capital or technology. We'll discuss both. Now, whenever I say because of capital, what is the growth in the GDP? Okay, that is what we are going to learn a very new term that's called capital deepening. What is capital deepening? Assuming the number of workers and alpha. Alpha is what? Alpha is the share of capital in the GDP. Remember, alpha is the share of capital in the GDP. So whenever these two are constant, increase in output will definitely increase the GDP. Increase in output means increase in GDP, right? Can be gained by increasing capital per sorry, capital per worker. So guys, when I want to increase the GDP and the labor is fixed, the only way I can do that by increasing capital per worker. Or I told you the other thing, that is by improving technology, that is TFP. So whenever I will increase at the same amount of labor, if I want to increase the GDP using capital, that is called capital deepening, or using technology, that's called tech TFP. TFP is technological progress or technological or total factor productivity. So guys, whenever the GDP at the fixed amount of labor, whenever the GDP is increasing due to capital per worker, that's called capital deepening. And due to technology is called TFP or technological progress or total factor productivity. Understood, everyone? So if the labor is fixed, the output can increase due to only two things: capital deepening, that is giving more capital per unit of labor, or due to technology. Clear, 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 everyone? Understood till this point? Okay. Now I'll discuss further that is this possible to do forever or not. And based on that, what is basically this is what we'll discuss. But later on, you will see there are many formulas related to the similar concepts. What is this formula? Some of them you might have seen in level one. Then you will see a very nice graph, and then you will see something similar as a formula here. This formula will look quite similar to what we've done. This formula again, and you will see one more formula out here. All of these are related, and they are all based on the growth rate of economy based on Cobb-Douglas. All of these are based on Cobb-Douglas. I'll show you one by one what are these formulas are and how to relate that and how to remember them, and should I even memorize them? Am I required to memorize them or not required? So until now, we've got the formula of output based on Cobb-Douglas and output per worker or per labor. Correct? That is GDP per capita. Now, there is one more formula which is change in output. And change in output is what I would want to connect. That is change in output or change in Y is same thing, similar to what you studied for output. Change in technology, change in capital, change in labor, and multiplied with their share. So see, when I say change in Y, when I write here, I wrote Y, but if I want to write change in Y means what? Y over Y, correct? Right? That is equal to change in all the three components: technology, capital, and labor. So see here, the technology, capital, and labor. Change in T, change in K, change in L. So I will write this is change in T, change in K, and change in L. Isn't it? Similar thing, correct? But now this is the main formula that we are going to use. So Again, if you see change in Y, same thing, change in technology, change in capital, change in labor. But this is the formula that we are actually going to use when they ask us what is the change in the GDP or change in the output, correct? And we will multiply with their share that is into now I'll write alpha and this is 1 minus alpha and this is the actual formula that we use because we are going to add all of that. We are not going to use to the power. That's just for your reference. But in reality, we are going to use this formula. This is when I'm finding the change in the output. Okay. So see, this is for total output. This is just for your reference. This is output per labor. This is also for theory. Main formula is this change in Y. This is what we are going to use where we are going to multiply with the alpha. Alpha is the proportionate share of capital in the economy or share of labor in the economy is 1 minus alpha. Now, again, you might wonder what exactly this is. We'll see one by one. So this F2, F3 and F4, I'm connecting this formula 4 of all these three formulas together. F2, F3 and F4. Understood? Again, this is Cobb-Douglas production function only. It is also growth in potential GDP, but expressed in growth terms. In growth means change, in change. So it's the same formula, but expressed in terms of change. Change means growth. Are you getting my point? Right? Expressed in terms of growth. So this is expressed in terms of growth accounting. We use a term called expressed in form of change is also called expressed in term of growth accounting relation. So this is the same, but expressed in terms of growth accounting. We use a word called growth accounting. So everything is expressed in terms of change. Otherwise, don't get worried that, sir, do we have two formulas? No, it's not two formulas. It's the same formula that I'm using, just that I'm making you understand how to apply it practically. All of this is under Cobb-Douglas production function. Clear till this point, everyone? Right? Okay. Okay, so let's come to this point. Now, here the word capital deepening is very much discussed. We are going to discuss about capital deepening again from the exam point of view. You don't have to memorize all of this thing. Okay. Now, alpha is the share of capital in the GDP. Okay. Additional capital has a diminishing effect on productivity. Very, very important. What does it mean? Guys, if it was only about capital, I can just simply borrow as much as money as I can and I can grow the GDP, right? Or I can just keep on printing the currency and I can do that, right? Well, that's what. By just adding more capital, you cannot increase the GDP forever. So out of the three components, labor, you cannot keep on increasing the labor. That's dependent on fertility rates or immigration policy. We'll discuss about that. Capital has a diminishing effect. The more and more capital you put will not forever give you high returns of GDP. They have a diminishing returns. The lower the value of alpha, the lower the benefit of capital deepening. Means if the proportion of capital in your GDP is less, right? So then you will not get the benefit of capital deepening. What is capital deepening? Capital deepening is basically when you increase capital, the GDP grows. Now, they are saying this is not useful for economy which are not capital intensive, which are more labor intensive, like India, Bangladesh. This is what they are saying. Okay. These economies are more labor intensive. Okay. So there, just by increasing capital, the economy won't grow. Okay. So increase in output, increasing. So they are saying additional capital has a diminishing effect on productivity. The lower the value of alpha means lower is the share of capital in the economy and more is the share of labor, the lower the benefit of capital deepening. But this is for less developed countries. Okay. Developed markets typically have high capital to labor ratio. So developed economies like Germany and Western economies, they already have high capital per labor. So now just by putting more and more capital, even they will not get high GDP growth rate just by putting more capital because they are already exhausted. So they already have a high labor to capital ratio and a lower capital lower alpha compared to the developing markets. And therefore, developed markets tend to gain less increase in productivity from capital deepening. Basically, what is the conclusion here? Capital deepening. What is capital deepening? Means increasing capital per worker. So I'll write down capital deepening is increasing capital per worker. Now, they are saying for developing economy which are heavily relying on labor, there is less benefit already. Correct? But developed markets also won't benefit because they already have peaked the capital per labor. So by putting just more and more capital per labor, the economy won't grow. So what is the recipe? How will the economy grow? The economy will grow by the third component, that is by technology. Understood? So yes, technology will thrive the economy in the long run, whether it's a developing or developed. But developing economy still has not enough capital. So they can still grow with more capital. But developed economy, they cannot put more capital. They have already invested too much of capital. So they won't grow by putting more capital. Okay. So this is what I want to show you. This is how it will look like. So before we read the next part, all of this, I want to show you what is productivity curve. Before I even discuss all this, okay, let me show you what is productivity curve. Productivity curve, if you notice here, productivity curve is a curve of labor productivity and capital. So capital per labor, this is K per labor, and this is output per labor, GDP per labor. Everything is in per labor terms. Remember our equation, output per labor, output per labor is this, is K divided by L. And what will thrive both? The technology. If you see output per labor and capital per labor, between both is technology. So let me show you how it looks like. So see, if you see the graph, it is going up. The productivity curve. What is productivity curve? Productivity curve shows the effect of increasing capital per worker on the output per worker. So if you put more and more capital, guys, what is happening to the GDP? Is it forever increasing or is it diminishing? Have you noticed that? Just by putting more capital, is the GDP increasing? Yes, it is increasing, but at a falling rate. That is, it is diminishing, isn't it? Understood? So this curve that you see here, guys, this curve and this curve tells you that at some point the GDP will not increase at a high rate. So that is called diminishing marginal utility, or diminishing marginal, here I would say, instead of utility, productivity. So see this capital deepening movement along the productivity curve. What does it say? The curvature of the relationship drives from diminishing marginal productivity of capital, which means just by increasing the capital, the economies won't forever keep growing. Why? Because guys, the capital is not unlimited and the capital has a cost. So the as long as the benefit is greater than cost, till that you can keep on putting more capital. But at some point of time, the cost will increase. Now, when I say cost is the return on the capital. That is R. R. R is return on capital. For example, let's say the capital is in the form of debt. So that is interest rate, isn't it? Correct? K is my capital, right? Y is my output. And you know, alpha is the percentage of GDP contributed to, alpha is the percentage of GDP share to capital, isn't it? Correct? Now, based on all this, there are two terms that we need to know. What is marginal product of capital? Marginal product of capital. Marginal product of capital means how much will be the increase in the GDP or output due to putting more capital. So marginal productivity of it is the additional output for one additional unit of capital. So for every additional unit of capital that you put in the economy, How much is the increase in the GDP? That is called marginal product of capital, MPK. That is called marginal product of capital. So that's an advantage, right? So this marginal product of capital is how much is the addition in the GDP for adding 1 unit of capital. They are saying this marginal product of capital is the increase in the output per worker for 1 additional unit of capital per labor. True. So for 1 additional unit of capital per labor, how much is the increase in the output per labor? Correct. Assuming that the increasing capital while keeping the labor constant, assuming the labor is the same, how much? So other factors are saying how much will be the increase in GDP for adding 1 unit of capital? That is MPK. It's a benefit. But this has to be measured against the cost. Cost is marginal cost of capital. What is marginal cost of capital? Is the cost of that capital is not free, right? So MPK is the marginal productivity of capital, and MCC is the marginal cost of capital. That is the rent on the capital, interest on the debt, or equity returns on the stock. That both are equal in a steady state of economy. They are saying if the economy is normal, then they both are equal. So this is the case when the economy is normal or at steady state or equilibrium. So in the equilibrium market, the MPK, marginal productivity of capital, and cost, both should be same. Both should be same. Now, how have they derived MPK? Again, you don't have to memorize, but this MPK is a component of three things. One is, first of all, MPK is the benefit, right? By adding 1 unit of capital per labor. So what is the increase in output due to the capital times by the share of capital into the economy? That is alpha. So it is alpha into output per capita. That is the benefit. What does it mean? You don't have to memorize this formula at all. I'll repeat, you do not have to memorize this formula. I'm teaching it just for your concept, not for memorizing for exam. You don't need to. No, 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 no. Okay. But what does it say that how much is going to be the increase in output because of every unit of capital? But capital is not the only contributor, right? So we multiplied with the share of capital. This should be equal to the cost of capital, that is R. R. These both things should match. Now they have just reshuffled. So what is alpha? Alpha is nothing but if I take R into K by Y, K is capital out of GDP. So how much is the capital? Let's say capital is $100, GDP is 400. On that, how much is the interest or capital charge that you're going to pay? That is alpha. So all the alpha that we did now, when I say alpha, alpha is nothing but exactly the same thing. This is how the alpha is derived. You don't need to know for your exam. Just understand and skip it. Okay. Overall, what is the conclusion that if the economy is steady, every 1 unit of capital that you put, okay, that will lead to increase in GDP, but that will exactly match the cost. Now, these two things should match. But tell me one thing, if the marginal cost is greater than the benefit, that is the marginal product of capital, will you put more capital or not? All you need to know is this. Till how long will you keep on putting more capital into the economy? You will keep on putting till the point where your benefit is more than cost, right? But at some point, if the cost starts increasing, then there is no point of putting more capital. Remember, this is what we learned in level 1, that was called diseconomies of scale. That was called diseconomies of scale, isn't it? So guys, see this. I will keep on putting more investment in capital as long as my productivity is greater than cost. Correct? But at this point, when they both match, this is what will happen in a steady economy. Beyond this, if I put more capital, if I put more capital, my capital deepening will not benefit. It will stop. It will stop means what? The benefit of putting more capital disappears. So conclusion is that I will not put more capital beyond a point where my MPK is less than R. Understood, everyone? That is where we'll stop. So here, guys, see effect of capital deepening. So this is the point where you will see what will happen after this point. Your benefit will start reducing than the cost. At some point of time, it will go opposite. So that is where you will see diminishing marginal utility. So now I'll repeat what is diminishing marginal utility. Economies will increase investment in capital as long as the benefit is greater than cost at the level of capital per labor for which MPK equals to R. Capital deepening stops and labor productivity becomes stagnant. Means now the only way to increase the GDP is not capital. Not capital. What is the only way to increase the GDP? Tell me. If capital deepening has a diminishing marginal utility, we discussed that. So I cannot forever increase the capital. So what is the only way to increase the GDP? Yes, please tell me. Yes, very important. The only way to increase the GDP is technological growth. Amazing. It is through technological growth. However, as technology progress occurs, both capital and labor can produce higher level of output. So investment in capital will definitely lead to technological progress. So they are also overlapping. It's not that they're completely different. They will enhance productivity of labor and capital. Technological progress, therefore, can lead to continuous increase in output despite diminishing marginal productivity of capital. Yes, this is the most important conclusion that you need to draw amongst all that I discussed, that capital has limitation. It cannot forever increase the output, but technology continuous progress in technology will continuously lead the economy. So US economy is growing, of course, not at high rate at what it used to be like China or India. The growth rate in GDP of China and India is highest. In fact, if you know the Goldman Sachs report that by 2050, India's GDP will be the highest. And the next century, they say, is of Asia and Africa. So anyways, the conclusion is that US economy as of date is still growing at a fast rate, and you will see that's because of the tech companies, not because of the oil and gas companies or natural resource companies anymore. That's because of the tech giants. All the top 10 most valuable companies, you will see they are all tech companies. Even Elon Musk says that I'm not a car company, I'm a tech company. Understood? So technological progress is the reason due to which the US and many of the Western economies are still growing. Okay, not because just they have more capital. Capital has a diminishing returns. Technological progress shifts the productivity curve upward and will lead to increased productivity at all levels of capital per worker. So technology at all levels of capital, technological growth, if it is higher, it will always increase the growth rate in economy. Understood, everyone? So labor productivity means the benefit of at constant labor, what will increase the GDP? Labor productivity is a combination of two things: growth in technological change and growth in capital deepening. But you know, capital deepening is diminishing, but technological progress is not diminishing. It keeps forever growing. Now, see how it affects both developed economies and developing economies. You see diminishing return to capital after a point. Now, can you tell me here which country has more share of the growth in economy from capital and which countries have less share? So see here, this has more share of capital and this has less share of capital. So of course, you will see the capital, the graph is diminishing. So it's a diminishing marginal utility. Now, these countries are different and these countries are different. But you will see this C1. C1 is a type of country whose majority of growth is not coming from capital, but majority of growth is coming from technology. This is bigger than capital. Can you tell me this C1 will be which type of countries? Developed or developing? They are developed economies. Why? Because majority of their growth is coming not from capital deepening. They are already having enough capital. So the only way for them to grow is through technology. Through technology. Understood, everyone? So the C1 is basically displaying that how developed economies, the capital per worker is already high. So for these countries have little to gain from capital deepening by putting more capital and therefore must rely on technological progress. And therefore you see these countries spend more on research and development, more on patents. Okay. So this is how the developed economies will be. But guys, developing economies like the BRICS nation, Brazil, Russia, India, China, South Africa, Nigeria, all of these countries, they still have scope of more capital because they are very much labor intensive still compared to the developed. Okay. So in contrast, the developing nations often have low capital per worker, correct? So capital deepening can lead to at least short-term increase in productivity. So if you carefully notice for developing economy, they still have very high return from capital deepening. They still have very high return from capital deepening compared to the developed economies. Understood? So they have the scope of capital deepening, but the developed economies do not have because they are already exhausted. Clear till this point? Everyone got it? Correct. Yes. Now we are going to talk in more detail about that, but just see this. Overall, when I say the growth in the GDP comes from three components, all the three components, the growth in technology, growth in capital, and growth in labor. Okay. This is the formula that we are going to use more. And the growth in potential GDP. Again, the three things. Long-term growth rate in technology, in capital, and in labor. But capital and labor comes up with their share. Okay. So this formula, I just translated this formula into growth in potential GDP because of the three things: growth rate in technology, growth rate in capital, and growth rate in labor, right? All these three things. So again, if you notice, we are doing the same formula what we did, but now we will just add the component here. So what I will do in the formula here, in this formula, we will just convert this formula again into a new term called growth rate in potential GDP. So I'll write growth rate in potential GDP. It is made up of three growth rates. So it is long-term growth rate, long-term growth rate, long-term growth rate. It's a measurement of three long-term growth rate. I will write long-term growth rate in what? In what? This is long-term growth rate in technology. This is long-term growth rate in capital. This is long-term growth rate in labor. But capital and labor comes with their share. So I will multiply both of this with alpha and 1 minus alpha. Understood this? Correct, correct. So growth in potential GDP is long-term growth rate of technology, growth rate of capital, and growth rate of labor. Understood? See, this is what they have asked me here. Land is an emerging market where labor costs account for 60% of the total factor. So labor share is 60%. So I can say this is 1 minus alpha. So my alpha is 40%. Correct? That is capital share. Long-term trend of labor growth rate is 1.5. So growth rate of labor into its share, 1.5 into 0.6 and 0.4 into capital growth rate, that is 3%. The country has benefited greatly from borrowing in the technology of more developed countries like Taiwan. They have substantially, and Korea, they have grown substantially from taking the technology from US, even Japan, and then now becoming self-sufficient in technology as well. Total factor productivity is expected to increase by 2%. So I'll add that together, all three will give me the growth in potential GDP. Understood? That is 4.1 simply. Clear, 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 right? Now, this is one approach, correct? Just to keep some discussion here of this, of course, the formula is done. I'll just do some discussion what they have mentioned here, that what happens in practice, level of capital and labor are forecasted from their long-term trends. So this is easy. How much is the growth rate of capital and labor that you can get from the past trends, correct? And alpha means the share of capital and labor can also be determined from national income accounts. National income accounts means the GDP numbers of the country. From that, I can get how much is the contribution of labor and capital into the GDP. Now, these two things in the formula, these things are easy to derive. What is practically not possible is to find the total factor productivity or the impact of technology on the GDP. So they are saying the change in total factor productivity is not directly observable. So even though for the calculation we are finding the growth in potential GDP, but in real life we do the inverse. We have the growth in potential, we have the growth in GDP between what was estimated and what was actual. So therefore, it must be estimated as a residual. That means the exposed change in output minus the output implied by exposed change in labor and capital. What does it mean? You don't have to memorize this. It means that in reality, we actually find this. In reality, we actually find this by taking the difference in this and these two components, that is labor and capital. So in reality, we might have the growth in the GDP, and from that we might subtract the growth due to the capital labor with its share, and the balance or the missing term is what is the growth due to technology. That is what the practical implication is. Got it, everyone? Clear, 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 right? Now, one more thing, if the labor growth accounts for majority of economic growth, analysts should be concerned with the country's ability to continue to increase labor force. This is very important. So if an economy is more labor intensive, then you will have to see that how the country will keep its labor force growing. So countries have to increase their labor force also, and we will see that either by immigration or by making more people work easily. For example, Saudi Arabia opened the windows for women to drive. That will put almost half of the population into workforce, isn't it? So that might be a very religious decision. No, it's a very economic decision, because by allowing women to drive and work, the labor force increases. And whenever the labor force increases, your GDP will also increase. Understood? So all of these decisions people feel are cultural decisions. I feel all decisions are economic decisions. The relation can also be used to estimate potential output. We will see, we just saw that. But as I said, practically we do the opposite. We find the technological growth from the balance. Okay. They have used another approach for forecasting potential GDP is the labor productivity growth. So we saw the growth in potential GDP, right? Now, another way, growth rate in potential GDP, they are saying growth in long-term rate of labor force, means how much labor force will increase, and growth in the labor productivity. But when I say growth in labor productivity, that is due to capital and technology. So labor productivity reflects both capital deepening and technological progress. So what I'll do is that I'll just add this formula. It is long-term growth rate of labor force. See here, another way to get this formula, again, the same formula. So growth, we are trying to understand the growth rate in potential GDP, same thing. But now it will come from the growth in labor force. So I will write the growth in labor force. Labor force, what is labor force? We will discuss that also. Plus the growth in labor productivity, the long-term growth rate in labor productivity. When I say labor productivity, so long-term, all this is long-term, by the way. So this is also long-term growth rate. I should rather write it long-term growth rate in labor force and labor productivity. Now, labor productivity means the productivity of labor is going to be because of two reasons. One is technology and second is capital. So because of these two things, only the labor will grow, right? So the labor productivity will grow. The labor's efficiency will grow due to two things: technology and capital. Technology and capital. That is capital deepening and technological progress. Am I correct? This happens due to two reasons. This happens due to two reasons. Capital deepening, we use a word capital deepening by putting more capital, and technological progress. Correct? Right? But labor force is by putting more people into the workforce. And what is labor force? Labor force participation. There is a labor force participation ratio also, means how much is the labor force out of the total working population. So labor force is the amount of working age population in the labor force. So that is the participation. This is called my labor force participation. We'll discuss about this. I'm not writing it right now to not confuse. The growth in labor force will happen if more people are working. More people are working. So out of your working age population, let's say my working age population is between 18 to 65. How many of them are actually in the job market? Now, whether they're employed or unemployed, that's a different story. How many of them are in the job market? That is called labor force participation rate. I will discuss where is labor force participation rate. See, this is what labor force participation is. Labor force participation is labor force out of the working age population. Now, when I say this labor force participation, it can increase as more women enter the workforce, isn't it? So I discussed the example of Saudi Arabia when they opened windows for women to work more by letting them drive. That will increase the labor force participation. But on the contrary, Afghanistan, when the new government came in, they stopped women from going out. So they are going on the opposite side when Saudi Arabia is going on the positive side. So that is called labor force participation, right? And when I say labor force participation, it actually labor force, the term labor force is actually all those people who are from the working age population. They are available to work, whether employed or unemployed. So labor force is all the people from the working age, whether they're employed or unemployed. Now, this is my labor force participation. So, proportion, what is labor force? Labor force is basically the amount of people from the working age population, number of working age population people available to work. So, I will write labor force. What is labor force? Number of working age population available for work. Available for work. Okay. And that can increase if the participation increases. So what is labor force participation? That is out there already. Labor force participation is labor force divided by working age population. So in Western countries, you will see the participation rate is very high. But in many countries, the participation rate is still low because women are not working. Got it? Understood? Everyone till this point? Yes, yes. Any questions till this point? So we've seen various factors which are relevant in terms of economic growth. Okay. Now, majorly our discussion was about labor and capital, labor and capital. But there are other factors of production which does play a very vital role in the economic growth. One of that factor is natural resources. Today, the world is fighting for natural resources, right? Now, natural resources are, when I talk about natural resources, we talk about renewable as well as non-renewable, majorly oil and gas. Okay, that's the primary focus. Now, of course, the country which have more natural resources, that does help in economic growth. Okay, but it's not straightforward. When I say the concentration of natural resources and the access to natural resources, these are two different things. Okay, for example, some countries with abundant natural resources have grown rapidly, like Brazil. Okay, they have enough natural resources with the Amazon forest, so they have really grown. But then some of the countries which are having huge amount of natural resources but have not grown as much as they should. like the African countries, especially I had a conversation with many of you all in the past also, DRC, Congo, right? Uh, I just read somewhere in one of the government documents that on an average, around 24 trillion dollar worth of natural resources are lying in the earth bed of DRC. These many natural resources, that's more than the size of US economy. Okay, but still the country is poor, of course, because of various reasons. So it's not who has more natural resources, but it's the one who has access to natural resources. Okay, now most of these natural resources are controlled by countries like China. Okay, so China benefits more of those natural resources in that case, and many other countries have control on the natural resources. So it's not the country which is gifted with natural resources, but the country who has access to natural resources. For example, Japan is not a country which has high amount of natural resources, but it has an impressive growth in per capita GDP. Even countries, you know, who do not have natural resources, but they grow because they have tactically had access to this. Okay, in fact, Japan is very much on the contrary of the opposite side of natural benefit. They have a huge amount of natural disadvantage with tsunamis and earthquake. Still, they have thrived. Okay, so it's not always that natural resources benefit, but of course, having natural resources will boost your economic growth. So Japan has managed to have high per capita GDP even after the fact that they do not have enough ownership of natural resources. Okay, this is one very important thing I wanted to mention, that natural resources, yes, it does help in economic growth, but it's not the concentration of natural resources, but the access which is more important. Understood? Right? But there are some contrarian views about having natural resources also. Something very interesting, okay? One theory says that the ownership of natural resources may actually inhibit growth. Inhibit means they may hinder or they may stop growth. You can write hinder growth. Why? Because they are saying that the country will be too much obsessed or focused on conserving those natural resources. So this country will be too much focused on maintaining those natural resources, so they'll put all their resources towards recovering this natural resources, so they do not focus on other aspects like skill, education, technology. So, because the country is too much obsessed with that natural resources and dependent on that, they may not have enough of focus on the other areas. This is one of the theory of how natural resources can backfire in terms of long-term growth. Okay. Also, there is another theory which is called the Dutch disease. What is the Dutch disease? Very interesting. Now, tell me one thing. If the country has a natural resource which is high in demand, what will the outside countries do? They will start demanding more of that natural resources, right? And the country's currency will, the country who possesses this natural resources, its currency will appreciate or depreciate? Appreciate or depreciate? Come on, tell me. Its currency will, yes, the country who has huge amount of natural resources like oil, many people will buy, that product from that country. So the local currency of that country will appreciate, isn't it? Now, when the currency appreciates, it's a good thing, but a bad thing for your exports because your exports become costly or expensive in the global market, isn't it? So this is called Dutch disease. Dutch disease is when the countries that own valuable resources find their currency appreciating as the demand rises, and this will hinder your long-term exports. It will suffer your exports, and so then you know what will happen. Where the global demand for natural resources drives up the country's currency value, your exports become expensive and will and rendering other domestic industries uncompetitive. So that will make your export industry uncompetitive because of the currency. So these are the ill effects of natural resources. More than the ill effects, the positives are much higher. So therefore, having natural resources is beneficial, but you need to know the other aspects of having natural resources, the ill effects of having natural resource. Clear? Okay. Same like natural resource, we'll now talk about the demography, we'll talk about the physical and the human capital and education and technology and everything. One by one, we'll understand the other factors, how they contribute to economic growth. Now, let me talk about demography. Okay, when I say demography means, basically the focus is on the population. So two important things about the population or the labor precisely, which is one of the very important factors of production. Here we are going to talk about the demography of the population, how young the population is, and about the immigration policy, okay, which is the talk of the town in 2025, thanks to Donald Trump. Okay, we are going to talk about two things. But as we already discussed, when I say quantity of labor is the size of labor force times the average hours worked. So how much job is done? So what is quantity of labor? Very interesting. It is defined as the size of labor force multiplied by the hours worked. So see this, when I say quantity of labor, it is labor force. And what is labor force? Labor force is those who are in the working age population. Those who are in the working age population and who are willing to work or available to work, right? Those who are in the working age population and are available to work. That is called the labor force into the average hours worked. So this will tell me the amount of job that is done. That is called the quantity of labor. Okay. This quantity of labor is dependent on various things. Number of factors include number one, demography. Demography is the feature of the population. As I said, demography means how much of this population is young. Okay. So country's population ages and individuals live beyond working age, the labor force declines. Yes, the labor force will decline if majority of the population are in the non-working zone. They are retired. Okay, like Japan or Germany. They have a huge population which is now on the retired side, right? But on the other side, countries like Saudi Arabia and India, they are said to have a huge amount of younger population, which will help their growth. Understood? Also, the demography globally is divided in such a manner that the fertility rates of many of the Western countries have desperately or have drastically gone down. On the other end, some countries' fertility rates are very high. Now, those countries which have a low or declining fertility, the only way for them to increase the labor force is by can you tell me something? How can they increase the labor force? The only way for them to do so is yes, allow foreigners to work, right? Or allow foreigners to enter into the country. That's immigration. Clear? So the reason why Germany, Canada has a very open door immigration policy is because they need the labor force. But that's not the case with all the countries. Ironically, Japan doesn't do that. Japan doesn't have a very easy immigration policy. Okay. Yes. So demography means how much of the population is young and what is the fertility rate. That both of them having a young population and high fertility actually boosts the economic growth. Ironically, in my entire childhood during my school education, I learned that population is a drawback. Having a population is a drawback, which is to a larger extent. But then as I grew up, I learned in economics that population is not a drawback. It's important how much of that population is skilled. Okay. It comes down to the quality of people, not the quantity of people. Okay. Right. Okay. Labor force participation, we've already discussed. It is a proportion of working age people who are in the labor force or who are willing to or available for work. This includes those who are employed as well as unemployed. But here we already discussed that adding more women to work will definitely be an advantage. Immigration connected to demography, as I mentioned, that having a immigration which is open door, of course, will boost the economic growth. Immigration possesses a potential solution to declining labor force. Okay. Do I have a question here? Yes, I have a question. What about the growth of householder member effect on economic growth of household? See, we are talking about here. I have a question. What about an individual household economic growth, right? No, we are talking about the aggregate economic growth. We are talking about the growth rate of the economy. So we are talking about the overall growth rate of the economy. Everything is from the macroeconomic point of view. What you are mentioning me is from the microeconomic point of view. right? Here we are talking about the aggregate economy, that is the total economy. Clear? Understood? Yes. Now, about immigration, yes, as we mentioned, immigration will be an advantage for countries who are having a decline in the population, right? Since developed countries have a low fertility rate than less developed countries, immigration represents a potential source or a solution for the developed countries. But the negative outcome of immigration is that many countries believe that immigrations will take away the job of the locals, and that's not feasible. So this might be economically very sound, but politically it is creating repercussion throughout the world. Okay. Average hours worked. Okay, now how many hours should we be working? Okay, globally the trend has been going downwards. Today, many countries are imposing limitation on how much hours should be worked so that people are less stressed and they can spend more time. Okay, possible explanation include legislation limiting the number of hours worked, the wealth effect, which includes individuals take more leisure time, isn't it? Right? And high tax rates on labor income and increase in part-time and temporary work. So these are the reasons due to which overall the number of hours worked by individuals are actually going on the downside. Okay. So these are the couple of reasons related to the labor supply. What will cause the labor supply to increase or decrease? Okay, everyone. So younger population, higher labor force participation, open immigration policy, and more number of hours work that will increase the labor, okay, or the labor force overall, or the quantity of labor. Clear? Right? We'll discuss about that. Data of this country is shown here. Based on this data, comment on the likely impact of the country's demographic change on its economic growth. Assume that the world population growth rate is 1.2%. So compared to the world growth rate in 2013 and 23, they've given us the labor force participation rate has gone up, correct? And the population is also relatively younger, isn't it? Two things. The participation rate is also going up and the population is also younger, isn't it? Correct. So they have said country's population grew at an average annual compounding of approximately 1.8% over the 10 years. How do I get this? Well, this is your ending value. This is your beginning value. So you can just simply take the ending over beginning, correct? And you can average it out. So they said 1 over 10 minus 1. If you do that, you'll get on an average around 1.8%. Okay, the simple compounded annual growth rate formula. Okay. Combined, so this is my population has grown by 1.8% when the global population is growing by 1.2. So my labor force has increased, plus the labor force is relatively young. So the participation has also increased. Okay, it should be above average, right? Also, the young population, all of these will help grow the country's economic growth, right? So the changes in per capita GDP are difficult to predict. Yes, so we can say the country will have higher growth rate in GDP, but we cannot conclude about the per capita. Output is expected to be higher due to increasing labor, but the larger population may mean there is no impact on per capita GDP. Yes. So the labor force increasing, the population being younger, all of these are reasons enough for us to conclude that the GDP will grow. But per capita GDP, question mark. We don't know about the per capita GDP. Okay. So whenever I say the labor force is increasing, we are talking about the GDP increasing, but not the GDP per capita. Understood? There's something interesting that I want to discuss here. If you see the population of the Middle East countries like UAE and Qatar, now they have the population has been increasing, but majority of the population is immigrants, right? Or expats. Now these are skilled expats because not anyone can come in these countries and work. You need to have certain criteria being met. So majority of the population is skilled, correct? But the citizens are not all of them are citizens, right? So the country's burden isn't increasing, but its GDP is increasing. A very smart strategy. Okay, something that the world economists should learn from the Middle Eastern economy, that how the economy is growing, not depending on oil, diversifying. I think somehow, they have done everything at right time, right, in a right manner. Okay, till now that has been really helpful, but now the future is on tech and other factors, so these countries are heavily investing and diversifying themselves from these economies. Okay, yes. So we discussed about labor force, natural resources, how they help us, how they help in economic growth. Now, quickly, we'll discuss about the other aspects of capital, like the physical capital, human capital. Physical capital, we'll talk about capex, human capital, and the most important, how technology or research and development will play an important role in economic growth. Okay, let's quickly talk about that. First of all, when I say human capital is knowledge and skill, basically, you doing CFA is a part of human capital. The more skilled the population, the higher will be the economic growth. Okay, so I don't need to go too much in detail about this. Increasing human capital through education or work experience increases productivity and economic growth. Understood? That will lead to innovation. So no need to go in detail about it. Physical capital means investments into capex. So physical capital is generally separated into ICT and non-ICT. What do you mean by ICT? The three terms: infrastructure, computer, and telecommunications capital. That is ICT, and non-ICT basically is machinery and other aspects. Empirical research has found again strong positive correlation between investment in physical capital and GDP. So this also helps. However, there is some discussion or debate by people that we just discussed in the part that capital deepening means putting more capital has diminishing marginal to utility, isn't it? So how come we are now talking that physical capital will boost the economic growth? Well, they are saying that we agree that there is some inconsistency in what we said in the past, that capital deepening has diminishing marginal utility, but that does not mean that the economy won't grow. Why? They are giving several explanations. Number one, that not all countries have very high rate of capital to labor ratios. Okay, many countries are still below that level, have relatively low capital to labor ratio. So increasing more capital will definitely lead to more economic growth. Okay, if you exclude the Western countries and US and all, then you will see not all countries have sufficient capital per labor. Okay. Second, they are saying that the capital investment can take different forms. What if this capital investment is going into technological growth? And we know that technology has a permanent increase in the economic growth, right? So capital investment, where actually it is ending up, that is more important. So if it is going into technological progress, then definitely it will keep boosting the economic growth. Okay. For example, the IT sector are termed as network externalities. What do I mean by that? That when you invest in these type of sectors, it has a multiplicative effect on the productivity. It not only boosts the economy of that particular sector, but various other sector, because IT is a backbone of various sectors. Understood? So that's called network externality, where the increase in a specific sector boosts various other sectors. Got it? So conclusion, physical capital does grow the economy. Okay. Finally, when I talk about technological development, it is nothing but a combination of two. Technological development is development of human and physical capital, isn't it? So it's man and machine, both. Investment in technology includes investment in both physical and human capital. Technology can manifest itself in process. What do I mean by that? That more investments into IT, softwares, research and development, all of these will boost the economy for all. So researchers have examined the proxies for investment in technology, such as research and development spending. So those economies who spend heavily on research and development or have more number of patent issued, like US, China, Korea, all these countries have heavy amount of patents and everything being registered. So that is where the high amount of research and development will definitely grow the economy. Okay. In contrast, we are going to understand what is going to happen to a developed economy and a developing economy. Who do you think spends more into technology or research and development? Of course, the developed economy. So developed countries tend to spend most on R&D. Why? Because they have little to grow from capital, but more to grow from technology. They rely on technological progress for growth, given their existing capital stock and slower population growth. So they are heavily dependent on technology, and therefore they spend majority of their amount in R&D, research and development. In fact, their taxation policies are also conducive to research and development. Contrast to this, the less developed countries often copy the technology innovations of the developed countries. Yes. Uh, China and Korea or Taiwan today are called as the ones who are copying the technology of the West. But you won't believe that in the past, Japan was being told as the one who's copying from the West. Over the period, you become an expert in that you become much efficient than the originating countries. Okay. So copying is not bad. Honestly, I don't think so. Copying a product is bad. No, no, no. Copying a product from a country's point of view, okay, and then making it more cheaper and more efficient and more futuristic or with more features, that's really going to boost the economy. I believe the biggest innovation might be done by Apple in terms of phone, but more than that, the innovation was from Android phones or Chinese phones who were giving so many features at some meager amount. So all those who cannot afford to buy the iPhones and the Blackberries during those era, they got all the features of that in perhaps less than $100 from a Chinese phone. So I feel Android is more of a revolution than iOS. This is what I believe. So basically, less developed countries, when they copy the technological innovations, they also start spending more in R&D. So they also end up growing. Okay. Ultimately, technological development should lead to increase in productivity as measured by GDP per worker. Yes, growth in technology can help grow GDP per capita also. Developed countries tend to have a very high level of productivity, while less developed countries tend to have a greater potential. So, both developed countries and developing countries both will benefit with this. Clear? The last thing we are going to discuss after discussing human capital, physical technology, we are going to discuss about the public infrastructure. Out of the infrastructure, we are going to discuss about public infrastructure, which is majorly done by the government spending. Okay, it's construction of public road, bridges, municipality facilities, and various other aspects. Okay, now this public infrastructure, does it benefit only the public sector or the private sector? If they are done to provide additional benefit to private investments. Now we are talking about those public infrastructure that will help the private investments also. For example, investment in distribution facilities by a private company would do little good without an interstate highway grid. Yes. So if a private company is investing heavily in some facilities, but if the government or the public spending is not efficient enough, if there are no roads, ports, or bridges to connect that, then what's the point? So private investment is useless if there is no sufficient public infrastructure at place. Both go hand in hand, and both one will private investment will only be beneficial if there is enough public infrastructure. And to be honest enough, the best public infrastructure that the government should always focus is on connecting the highways. Okay, rail through rails or roads or whatever means of transport. Highway system is said to be one of the most efficient form of public development. Okay, because it connects end to end. Once there are highways, then you can put up the cable lines, then you can put the optical fiber, you can connect the technology, you can bring the internet to those remote areas also. Once you do that, done, the economy has to grow. Okay, therefore enhances total productivity for economy by completing private investment and increasing TFP. Okay, very interesting, isn't it? Okay, yeah. So let's discuss about this case study. We did a couple of questions. Now let us do the rest. Based on the World Bank report, which of the following conclusions is most likely regarding this mini cars? Okay, what were we discussing about mini cars? Well, mini cars is an emerging market economy experiencing moderate growth in 4 years, some stagnation in the past. Changes in government policies are expected. Okay. Now, the question basically they have asked is that which of the policies or based on the World Bank report. So I need to find something regarding the World Bank report. Has there been any mention about the World Bank report? It has been okay, expecting growth, experiencing technological separately, evaluates a neighboring country, Kinimas, okay, had a labor growth over the same period. Kinimas GDP comparing two countries, high amount of natural resources endowments. He concludes that Minica's relative lower GDP growth is due to lack of natural resources. Do we see anything related to World Bank? World Bank? No. As of now, no. But they are saying based on World Bank report, which of the following conclusion is most likely regarding Minicas? Its inflation is 1.5. Do we have any information about the inflation being 1.5 out there? Do we have any information about the inflation being 1.5? No, we don't have any such information. In fact, they said us that the other country is growing okay, but we don't have any information about the inflation of our country. Okay. Next, Minica's government is likely to follow restrictive fiscal policy. Now, what is restrictive fiscal policy? It is when the government is going to spend less or tax more. Okay. It's going to spend less or tax more. Spend less or tax more. Okay. Now, they have said the inflation is going to be stagnant. So we are not expecting inflation to be very high. They have said the GDP will grow as a percentage of GDP. Okay. Experiencing actual potential GDP, approximate GDP of 2.5 percentage. Okay. Yes, we are discussing about whether the government will follow a restrictive fiscal policy. Restrictive fiscal policy means the spending will be less. Here we have been seeing Smith is evaluating changes in government policy that will foster the high level of economic growth. Now, government is trying to boost the economy, so it will not have a restrictive. It will rather have a easy fiscal policy. Means it will not be restrictive. It will be more expansionary. So that is not possible. Correct. Third, Minica's central bank is not likely to be worried about inflation. Now, see, if the central bank was worried about inflation, it would increase the interest rates. Okay. Now, here they are saying that is inflation a problem? Is inflation a problem? Let us see. Let us see. Is there inflation a problem? Low entry barriers will expand reviews. Okay. The report indicates real growth rate is 2.5. Okay, separately, World Bank's, yes, World Bank reports indicating Minica's potential GDP is 4% and that it has been experiencing actual GDP of 2.5. Now, this is very important. Now, the potential GDP is more and the actual GDP is below the potential GDP. Now, the inflation becomes a concern when the actual GDP is higher than the potential GDP. So here, will the central bank be concerned about the inflation? No. So that seems to be a right answer. What is the reason behind that? The reason behind that is the potential GDP is more, the actual GDP is below the potential GDP. It becomes a concern when the actual GDP is way higher than the potential GDP. Yes. Next, using Cobb-Douglas production function and the concepts of capital deepening and total factor productivity, which of the following outcome is most likely? Yes. So we are going to see what are the outcomes. First, let us read that Minicas will experience increase in sustainable growth of per capita output due to increase in capex. See, increase in capex will increase the GDP, but not necessarily per capita. Okay. There will be no short-term increase in per capita output, or there will be both short-term and long-term increase in the GDP growth rate. Let us understand what causes increase in short-term and long-term GDP growth rate. They have asked using the Cobb-Douglas production function. Now, Cobb-Douglas production function that we saw, based on that, what is going to be the outcome? Yes. Will there be short-term and long-term both, or only one? Everyone. Smith reviews Minica's national income accounts and find that it is experiencing both technological progress and making increase in capex. Now, technological progress will definitely lead to long-term growth also. And since the country is emerging, it will have advantage in short term. See, capital deepening helps those countries which are emerging countries. So it helps them, right? If it was developed, then capital deepening won't benefit. But since it is underdeveloped, capital deepening will result in short-term growth. But since the country is investing in technology, it will have long-term economic growth also. So both will be the outcome. The outcome will be both. Got it, everyone? Right? Yes. Now, using the Cobb-Douglas relation, total factor productivity. Yes. What is a Cobb-Douglas production function, guys? Y equals to three things. Yes. Do I have a question here? Yes. Okay. Three things in Y. One is total factor productivity, that is technology, plus capital into alpha plus labor into 1 minus alpha. Right? Now, we already discussed that practically the equation, we theoretically we are finding the GDP or the output, but in real life we are more of finding the technological progress, because that is difficult to identify. Okay, so they are saying total factor productivity for kinemas is closest to, let us understand all the components that we have. Y equals to, yes, so we do have some of the information that they have given here. Do we have the increase? Yes. Kinemas, they have asked, remember, they have asked about the other country, kinemas. Okay. So for kinemas, we have the GDP is going to grow by 3.7. Okay, everyone. So we have got the information that the GDP will grow by 3.7 percentage. Okay, we are looking for total factor productivity. Now we are going to look at capital and labor. Okay, so for capital and labor, they have said us that the how much is going to be the growth in capital and labor. Growth in capital, yes, yes. Do we have that information? Yes, they have said kinemas has a labor growth of 2% over the last several years and capital of 3%. So 2% of labor growth, sorry, am I correct? 2% of labor and 3% of capital. So 3% of capital and 2% of labor. But now I need to know the share of labor and capital, okay, in the economy. So they have mentioned us that over the labor share of total output is limited to be estimated to be 60%. So 60% is the labor, which is this. So this is going to be 40%. Am I correct? Yes, all the inputs we have. So let us find the T. Yes. Can we calculate T? Yes. We have 3 into zero point 0.4, 3 into zero point 0.4, store 2 into zero point 0.6 plus recall 1 minus 3.7. You will get the answer. Yes, everyone. Very easy. Correct. B 1.3, everyone. Right, right. Easy. Okay. Next, Smith's conclusion about Minica's relatively lower GDP growth rate is most likely correct or incorrect. Is it correct? Lower growth rate of GDP? Everyone? They are saying conclusion about Minica's is relatively lower GDP growth rate. First of all, let us see why is he saying lower GDP growth rate. Comparing the two countries, Smith notes that Kinimas has substantially higher amount of natural resources. Okay. He concludes that Minica's relatively lower GDP growth rate is due to lack of natural resources. Guys, we discussed that natural resources, having low natural resources does not mean that your economic growth will be low. It is the access to the natural resources that is more important, isn't it? Correct? So let us see the conclusion. Is it correct? Well, partially we can say, but not always. Correct, because in some cases, natural resources may inhibit economic growth. Okay. Incorrect, because access to natural resources is more important than ownership. Everyone, which of the statement do you agree with? ABC, everyone. First of all, it's incorrect, right? Because it's not a outright no when you don't have natural resources. We saw the example of Japan. So the answer is C. Everyone got it? Clear? Yes. Next, data for labor market of countries X and Y over the past years appear. So I have X and Y. Unemployment rate of X is high. Population below 15 is high. Average uh, hours worked are also high. Immigration growth is also high. Okay. Both countries are expected to have moderate economic expansion over the next several years. Which of the following statement is most accurate regarding labor input of the countries in the next several years? Now, when I say about the labor input, we need to see which country will have a much higher younger population. Now, if you see percentage of population below 15, X has more amount of that population, more hours worked, and a better immigration growth. So relatively, X will be at more advantage in the long run, correct? So X will have more opportunity, and there is already a good amount of unemployment out there, right? So inflation is not a concern. Unemployment rate very low, inflation is a concern. So country X will have greater opportunities to increase labor, correct? Country Y will have no, neither, no. So what will be the answer, everyone? Because of younger population and high immigration growth rate, everyone, which country will have a much higher growth rate? Yes, A. A. Which of the following would least likely have externality effect of on output growth for an economy? See, externality effect is with which one? Which one? Yes, multiplying effect. Externality effect means multiplying effect. Human capital investments will have a multiplying effect or not. They are asking which of the following would least likely have an externality effect. Yes, can you try and tell me which one? Which one? ABC, human capital investments, ICT or non-ICT? Yes, let me see the answers. Everyone would try. Only one answer I've got. Very good. What about the others? Try. What is ICT? ICT is infrastructure, computer, and telecommunication. So just writing the full form, ICT is infra, computers, and telecom network. Okay. Well, we definitely know that ICT has a multiplying effect. So which one does not have a multiplying effect? Everyone in the class, come on. Yes. C. Non-ICT. Clear? Clear? Let me see everyone's answer. Okay, perfect. Right? Okay. Now, let us go and understand the last section of what are the different theories on this growth. Okay, we have three theories basically talking about the growth. Now, most of these theories are going to talk about whether there will be what the comparison is going to be between developed and developing countries. Means that will the developing countries ever become developed? That's the main objective here. So the theories of economic growth are largely separated into three models. We are going to discuss about classical growth theory, neoclassical, and the third, which is the most important, which is endogenous growth theory. Now, there's a lot of unnecessary information here, okay, from your exam point of view. Practically, it's very interesting, but from your exam point of view, because the weightage is very less, I don't want you all to go into deep into memorizing a lot of things. You will see a lot of formulas out here, okay. You might not have to memorize it, but we will still discuss that. We will still write those formulas, okay. Let us understand one by one, and I will tell you the keywords that you need to understand so that you will be able to tick mark the answers. Okay. Rarely they will ask you question related to it. Okay. But there are formulas with respect to this neoclassical theory. Otherwise, there's nothing complicated out there. Okay. Classical growth theory. We'll discuss the classical or the traditional theory. Remember, in generally, whenever you see a classical theory, it's the old theory which is generally, discarded because it's based on some traditional thought which doesn't become relevant in today's world. So most of the classical theories we discuss, but they do not have relevance in the today's world. Okay, everywhere. Now here the classical theory is based on some English economist called Thomas Malthus, based on his version of economical, growth rate. Now, what does this theory say? It points that the long-term population growth increases whenever there are increase in per capita income above the subsistence level. So whenever the GDP per capita is greater than something they call as subsistence level. Now, whenever this happens, what is subsistence level? First of all, let me discuss subsistence level is the minimum income needed to maintain life. To maintain a standard of life, what is the minimum income we need? That's called subsistence level, or you can say the survival level. Okay, or survival means of standard of living. So it's much more than survival, but the minimum that you need to maintain your standard of living, that's called subsistence level. So if the GDP per capita is higher than that, definitely many people will be attracted towards that country, right? So these country will definitely see a high population explosion. So the population growth will substantially increase of such countries, right? Classical growth theory contends that the growth in real GDP is not permanent, GDP per capita. Why? Why is it not permanent? Because they are saying no country can forever grow at a rate higher than the subsistence level. Why? Because others will come in, and then the population will increase, and then it will lead to a point where the GDP per capita won't rise because of too much population coming up. So they are saying the GDP per capita is not permanent, and the reason they are saying is because there will be population explosion. It can be either internally, where people are having more children, or it can be due to people coming from outside. Why is this theory not relevant today? Why is this theory not relevant today? Because it's not easy to bring in the outside population unless the country allows you. And many countries in Europe, even though they have a very high GDP growth or GDP per capita, they don't have such an open door immigration easy policy. Neither is their fertility rate going up. Okay, so population growth, if assuming that the population can easily grow with high GDP per capita, if that happens, then that will lead to diminishing marginal returns to labor, which means what? It will reduce the GDP productivity and drives the GDP per capita back to subsistence level. So basically, the GDP growth rate of per capita is not sustainable. Why? Because the population will also grow, and per capita GDP will come back to the normal level, right? So the mechanism would prevent long-term growth in per capita income. But this has been not supported by the historical evidence. For example, Switzerland and many of the European countries, they have, and even US for that matter, they have consistently been able to have a high GDP per capita, even though the population is increasing. So that this theory becomes invalid. Okay, right? Conclusion, they are saying the GDP per capita cannot grow forever, right? And the population explosion or the growth in the population will set off. Okay, so the GDP per capita growth high is not permanent. Okay, but again, this theory has no more relevance. Now, therefore, we will talk about the neoclassical growth, and there's a big comparison between neoclassical and the next theory. Okay, the endogenous one. Neoclassical's primary focus is on estimating economy's long-term steady state of growth. Remember, in equity, we learned sustainable growth rate, sustainable growth rate. So that sustainable growth rate, just giving you the formula remembrance, is retention ratio into ROE, correct? That sustainable growth rate is what this particular theory talks about. The growth rate which can be consistent in the future, right? The economy is at equilibrium when the output to capital ratio is constant, means output to capital, that by putting more capital the output won't grow. Okay, or the growth in the output will not be high because of just adding more capital. Now they are saying when this is constant, the capital to labor ratio and the output per capita also grow at the equilibrium growth rate. So basically, the output per capita means the GDP per capita will grow at a constant rate. And the meaning is that the population growth is independent of economic growth. So, two things you need to understand, that the output per capita grows at a constant rate, and the population growth has got nothing to do with the economic growth. So it is independent. It is contrasting the classical theory. I'll repeat. The growth is constant, right? And the population growth is independent of the economic growth. We are not connecting the two here. That is what the neoclassical theory says. So, okay. Now, based on this, there are two formulas here based on the Cobb-Douglas function. Sustainable growth of output per capita and total output. So this is this formula, both the formula I'll discuss. This first formula is for per capita, right? And this is for the total. Now, the only difference you will see in the formula is the change in labor when I talk about the total. Okay. Now, what is this theta and divide by 1 minus alpha? That theta is the growth rate in technology. So basically the formula is we are looking out for growth in output per capita or growth in GDP. So we are looking for growth in GDP either per capita or total. So this is growth in GDP per capita, the first one, and the second is growth in total GDP. Okay, per capita and total. Now, both are based on the growth in technology. So it is growth in technology divided by 1 minus alpha. Remember, alpha is the share of labor, share of capital. 1 minus alpha is the share of labor. So divided by 1 minus alpha, that is labor share in the GDP. So in both the cases, I divided by 1 minus alpha, 1 minus alpha. But when I look for total growth rate, I add one more thing, that is change in labor. Now, honestly, if you ask me personally, I don't expect this formula to be tested in exam because they have so many things to test in economics. And for just a meager 3 or 4 questions, this is rarely tested. But just for your reference, I'm putting up this formula. It is growth in technology divided by the share of labor in the GDP, that is 1 minus alpha, plus change in labor if they ask you for finding the total growth in the GDP. Okay. Now, here, if you notice how the question will appear, let us see that analyst is forecasting steady state of growth. Steady state of growth basically means not the not the classical, but the neoclassical growth here. Okay. Steady state of growth. This is nothing but for the neoclassical. Okay. Country X and Y has collected, they have TFP growth. TFP growth is the growth in technology, which we say here the theta. Labor force growth rate and labor cost as proportion of total factor cost. This is nothing but 1 minus alpha. Okay. This is basically the change in labor. Calculate and comment on sustainable growth rates for two country. So they are asking for sustainable growth rate, not in per capita, in total. If they use the word per capita, then I will require only the first part of the formula. But when they say just the growth rate, then I will add the change in labor also for both the countries. Understood? Because then my formula is theta over 1 minus alpha plus change in L. Correct? So I have this as my theta divided by the share of the labor plus this conclusion. What do you see the conclusion? Country X has relatively very marginally high growth rate, correct, in the GDP expected. But more than that, what you need to analyze is where is country's X majority growth coming from? Is it coming from the growth in labor or growth in technology? Growth in labor or growth in technology? Yes. Where do you see comparatively that your focus should be on that? If you notice, country X majority growth comes from growth in technology, while country Y's majority growth comes from labor. Understood? Right? Country X sustainable growth rate is primarily driven by high growth in technology, while country Y is more driven by population growth rate because that will increase the labor. Understood? Clear? Right? Okay. Yes. They have given some conclusion about the neoclassical theory. We'll just discuss. Now, what do you notice in this formula? One interesting thing that you notice in the formula, what is missing? Technology is there, labor is there, the capital is missing, right? Or the concept of capital deepening is missing, isn't it? So under neoclassical theory, capital deepening affects the level of output. Yes, means capital deepening will increase the GDP, but not the growth rate in the long run. This is the most important thing. And therefore, you notice in the formula, there was nothing mentioned about the capital. We only talked about the labor and technology. Did you assume that? Did you observe that? Correct. So they are saying for temporary, yes, temporary, it will increase the growth rate, but it is not sustainable because of the diminishing marginal utility. And it is only possible if there is a technological progress. So conclusion, capital deepening will not lead to long-term economic growth. Okay. Economics growth rate will move towards its steady state regardless of the initial capital to labor ratio or level of technology. So in the long run, it will move to the steady state. Steady state. It will not keep growing it forever at a high rate. Understood? Now, what is a steady state? The growth rate in productivity is a function of only growth of technology and labor share. This is what we understood, that in a steady state, only two things will help the economic growth, that is technology and labor, not capital. Capital deepening is only temporary. Very important. Okay. Now, we discussed about marginal productivity, correct? How long should you keep on adding capital? Till the MPK is greater than cost, isn't it? So in a steady state, marginal productivity of capital is constant, but marginal productivity is diminishing. That means there's no point of adding more capital also. So again, MPK is also constant, but diminishing. So if you put more capital, it will have diminishing returns, right? And increasing savings will also help, but temporarily only. So any form of capital, even outside capital, whether you save, okay, even if you save, that savings will result into more investments, but again, that investments will not increase the economy forever. So however, countries with higher saving rates will enjoy high capital to labor ratio and high productivity, but again, this is only temporary. Developing countries, however, will be impacted by less diminishing marginal productivity of capital, isn't it? We discussed developing countries do have still some scope of capital deepening, isn't it? So therefore, and hence having a higher growth rate as compared to developed countries, there will be eventual convergence of growth rate. So initially developing countries will benefit because of capital, but in the long run, they will converge, means they will, at some point of time, they will meet the growth rate of the developed economies, and then the benefit of capital deepening will disappear. Conclusion, in the long run, technology and labor both will only result in high growth rate. Understood? Now we've written all the several formulas. I will just write down one more formula which is related to the neoclassical theory of growth rate. So the neoclassical theory of the growth rate. In this, we have two forms of growth rate. We are talking about sustainable long-term growth rate per capita. So growth rate, basically this is per capita. It talks about sustainable long-term growth rate. And when I say growth rate, means everything is about the economy. Growth rate. Okay, economic growth rate. So we calculate GDP growth rate per capita or growth rate in total. They don't use this word total, but I'm just writing it. So both has one thing common, that it is growth in technology, which they refer as theta. Okay, divide by 1 minus alpha. 1 minus alpha is the share of labor in the progress, share of labor. 1 minus alpha is nothing but share of labor in the GDP. Okay, now this formula is common under both, so I will just simply copy this. So I will just write down, this is common here. So here it is theta divided by 1 minus alpha is the same. Plus one more thing we have is the change in labor. This additional thing you do when they ask for the total. Okay, clear? Right? Rest of the formulas I've already plotted here as well, and also in the notes, correct? Which will be attached. So two theories we've understood is the classical theory and the neoclassical theory. Okay. Now, again, the neoclassical theory mentioned that the growth is related to technological progress and the progress of and the labor increase in the labor, right? But endogenous, the word endogenous means within or inside. Endogenous means within or inside. Okay. Now, in contrast to neoclassical, endogenous contends that technological growth emerges as a result of both physical and human capital. So the technological growth will come from physical and human capital, isn't it? So the technological progress enhances productivity, yes, but of both labor and capital. So technological growth and the growth in labor and capital all will happen hand in hand. Okay. It's not differentiating between that. Okay. Unlike the neoclassical model, there is no steady state of growth. So the increased investment can permanently increase the rate of growth. Yes, this is the biggest differentiator. Now, in the in the neoclassical, it's said that by just adding more capital, there cannot be permanent growth in the economy. But here, the endogenous growth theory actually says that, of course, the change in technology will result in change in human and physical capital, and by increasing more investment in that you can have a permanent increase of growth. This is the biggest difference between this theory and the previous theory. So it pushes you to invest in human and physical capital, and that will boost the economy. That will have an effect on the technology also. The driving force behind the endogenous growth theory result is the assumption that certain investments increase TFP. Yes. From a societal standpoint, increase in R&D, for example, benefit the external benefits results in benefit that are also external to the firm making R&D. What does it mean? That when you are increasing in research and development, it doesn't only affect that industry, but we also discuss it has a network effect. It actually benefits all the other industries. So overall, the model says that the returns to the capital are constant, correct? The key implication of constant return is that the effect of increase in savings, the endogenous growth model implies that an increase in savings will permanently increase the growth rate. Yes. Now, remember the neoclassical theory said that increasing saving will just lead to a short-term increase in the growth rate. Here they are saying no, that will lead to permanent increase in the growth rate. What if that saving is going into research and development? That saving is going into investment into research and development, then that will boost the technology. Okay. So the biggest differentiator is that neoclassical said that, you know what, savings and investments will not boost the economy forever. Endogenous says, no, what if that is going into technology, right? The difference between both relate to the total factor productivity or technology. Neoclassical, which we studied, assumes that capital investment will expand as technology improves. But endogenous says that capital investment may actually improve the total factor productivity. So it's the other way. Neoclassical says, what does it say? That capital investment will expand as the technology improves. So technology will attract capital. That's what neoclassical says. Endogenous says the opposite. Endogenous says what? That the capital investment, especially research and development, that will boost the technological progress. So it's the opposite. Understood that difference? Correct? So neoclassical says that increase in technology will attract capital, but its effect, capital's effect will be temporary. On the other hand, endogenous theory says that, hey, you know what? If you increase capital investment, that will boost more technology and it will have a permanent effect on the economic growth. Understood, everyone? Correct, correct, correct. Now, there is a question related to it. I'll just discuss with you how the question looks like. Okay, first of all, let's see question number. Which one? Question number. Yes, look at question number 3, everyone. A chief economist argues that government policy should include an additional tax break for research and development. Yes, research and development should give you more tax benefit. Okay, they should give you a tax break, or Many countries have this research and development. If you spend 100 million on research and development, you can reduce your taxes by twice of it. In fact, if you notice, US gap policies, they allow research and development both to be not capitalized, expense. So US companies, they can expense their development related expenses also. That will lower down their profits and taxes, isn't it? So US gap actually pushes for more tax savings on research and development. That's why you see US companies are, you know, even Apple might have its manufacturing unit in China, but its research and development is in California, right? The reason is that because the US, uh, tax policies are more conducive for pushing the research and development. Understood? So government policy definitely will increase the growth rate, right? Which theory mentioned this? Not classical, not neoclassical. Who said that more capex into research and development will boost the economic growth? Yes, yes, yes. Everyone, which of the theory? A, B, C, we just discussed. Correct. Everyone in the class? A, right? The endogenous theory. Correct. First one, country X has output elasticity of capital of 0.6, means the share of capital alpha is 0.6. Okay, we need 1 minus alpha. Remember, its total factor productivity growth is 1%. That is my theta. What is the sustainable growth rate in output but not per capita? They ask me total output. So growth in total output is theta over 1 minus alpha plus the change in labor or the increase in labor. Okay, so my answer will be total factor productivity is 1% divided by 1 minus alpha, that is 1 minus 0.6, plus the population growth rate or the change in labor will be 2%. I'll add 2%. Let us find. Remember, if they said per capita, then I will not include that 2%. Okay, right? So we'll do 1% divide by 0.4 plus 0.02. I'll get 4.5. Easy, everyone, right? Although the question is mentioned here, but don't go too much into memorizing this. It's going to be too much for you. But yes, just be clear that if they say total, then we use this. If they said per capita, then I will exclude the change in L. Clear? Okay. Yes. Okay. Okay. Now, something related to this we are going to discuss. Okay, remove barriers. Okay, trade barriers we haven't discussed here now. Okay, diminishing. Yes. Knowledge and physical capital. Have we done knowledge and physical capital, everyone? Yes, we've discussed about knowledge and physical capital, right? Can we do that? Can we discuss this? Or maybe we'll discuss that when we go into that knowledge and capitals precisely. Okay, clear till this point, everyone? Now we are going to discuss what is the convergent hypothesis. Convergent hypothesis actually addresses the issue that will the underdeveloped countries ever develop? Okay. And then we will understand the influence of knowledge and trade barriers. Yes, countries' trade barrier, how will they help us have economic growth rate, high economic growth rate? Okay. Let us understand the convergence. Now, what is convergent hypothesis? Now, first of all, we now need to understand that the differences between productivity per capita of GDP of various countries is too high. If you see the GDP per capita of the top countries like US, Qatar and all, that's in multiple $1,000s. And then countries like India and other countries, their GDP is 1/10 of it. In fact, much lesser than that. So this gap is huge. So even if the GDP of countries like India is increasing, its GDP per capita is not increasing at a high rate. Of course, China has been an outlier that its GDP per capita is rising substantially, but still it hasn't converged or met to the GDP per capita of the developed nations. Okay. So will this differences will ever be addressed? So the larger the difference between the productivity of different countries with less developed countries experiencing much lower output per capita. What is the reason? Historically, we see this, right? So the conclusion is that Will the living standards ever converge? Will they ever meet up? Will the underdeveloped countries, will they ever meet to the GDP per capita or standard of living with the developed countries? Will that ever happen? Okay, that is the question that we are trying to address. Now, based on this, there are some theories. We are going to discuss the three views. One is absolute convergence, second is conditional convergence, and third is a club convergence. Very interesting thing. Absolute convergence says yes, it's a good news. That don't worry, these underdeveloped countries, they will eventually meet the standard of living of the developed nations. Okay, that's what they are saying. Very positive. They believe that yes, less developed countries will converge to the level of per capita of developed. The neoclassical model assumes that every country has access to same technology. So they are saying countries, there is no difference. Everyone can access technology these days. And because of that, the other countries will also eventually match to the developed nations. This leads to countries having the same growth rates, but not at the same per capita income. The model does not imply absolute convergence. The neoclassical model supports the conditional convergence. So, before I come to this point, this leads to countries that having same growth rate but not the same per capita income. As such, the neoclassical model does not imply absolute convergence. So we did discuss that absolute convergence means what? Absolute convergence means yes, countries will eventually reach to the developed nations. Okay. But that is not always the case. It's subject to some condition. What are these conditions? The conditional convergence says that convergence in the living of standard will only occur for the countries with the same savings rate, population growth, and production function. So what you need to remember that absolute convergence says that, oh yes, it will eventually reach. Why? Because everyone has same technology or everyone can get access to the same technology today or tomorrow. That is absolute convergence. Okay. So outright they say, yes, it will happen. Okay. But conditional convergence does say that this will happen, however, subject to some conditions. Some conditions include that the countries will have high savings rate or same savings rate, population growth, and production functions are similar. Only then. Under this, the growth rate will be higher for less developed countries until they catch up. See, the less developed countries, they will have to grow at a higher rate for maybe 30, 40 years or maybe a couple of decades to reach to the developed nations. Now that seems quite impossible theoretically, but China has done so. India has been growing at a real growth rate of 5 to 8 percentage on an average in the last decade or so. So today, if India reaches to that level and maintains this growth rate for the next 15, 20 years, it can become China. Okay. China has shown that to the world that it can consistently have a high growth rate. Okay. Yes, so that is possible. Under neoclassical model, once a developing country's standard of living converges with the developed, the growth rate will then stabilize to the same steady growth rate of developed. So eventually it will match the developed. It cannot forever grow at a high rate. So China will become US at some point of time, or India and China will become to US at some point of time. In fact, the Goldman Sachs report says that by 2050, they will already have become developed nations. Okay. Now, the only difference between absolute convergence is says that yes, it will happen irrespective of anything. Conditional convergence says that it is subject to some conditions. Okay. But the third view, which is very interesting, is the club convergence. Club convergence, this is very interesting. You know why? Because here, and it's very true also, that countries have become a part of club. So only those countries which are in that club, they will grow. So these countries which have similar institutional features or property rights or educational services like the Quad, the four, the US, I think Canada, Australia, and UK. And similarly, the NATO nations, the US and the European nations, they are like a club. Okay. Of course, these clubs are more The names that I mentioned are more, from the military point of view, but they are also economically, they are like a club. They are connected. US, Western countries, and Japan, even Korea and Taiwan. Okay. So, under the club convergence, poorer countries that are part of the club will grow rapidly to catch up with the richer peers. So, if you are a part of the club, great, you will catch up with the rich countries. Countries can join the club by making appropriate institutional changes. So, yes, one of their condition is that, oh, you have to have, your country should be democratic. Like Turkey is struggling to become a part of European Union, but European Union says that we have certain criterias. Okay, those countries that are not part of the club may never achieve the higher standard of living. This is what the theory says. I know it sounds very brutal, but that is the fact. In fact, empirical evidence have shown that developing economies often reach the standard of living of more developed ones, but not always, as I said, if they are part of the club. So as I said, China has shown that even after it was not a part of the club. Okay, right? Over the past half centuries, about two-thirds of the economies with lower standard of living than US grew at a faster pace than US. Very positive, right? So they are saying more than two-thirds of the countries whose growth rate was below US, they have increased their standard of living. Yes, with a lower standard of living, they have grown, though they have not converged to the standard of living of US. So ironically, even though this country's GDP has been growing at a high rate than the US, it's still taking time for them to meet the standard of living of US. When I say standard of living means per capita GDP. Got it? Right? Correct? The club convergence theory may explain why some countries that have not implemented appropriate economic or political reforms still lag behind. So you have to be a part of the club if you want to grow. Understood. South Korea has understood that. Japan understood that. Taiwan understands that. Okay. So if you are a part of this, the West Club, then of course you will end up, having a developed economy, and historically it has been evidence. Got it? Yes. The three interesting theory. Okay. Now we will discuss how governments can help the economy to grow by giving incentives in technology like research and development, right? So here we are going to talk about the role of incentives provided by government, in the economic growth. Of course, the government cannot alone grow the economy, so it needs to give incentives to the private companies to do so, because if the private companies do research and development, not all of that is commercially beneficial. So government needs to support that. Firms accept project when they provide returns which is higher than their cost of capital. Correct? Under endogenous growth theory, private sector investments in R&D will benefit the overall society also, isn't it? We discussed that. Correct? Correct, correct. For example, new technology may initially benefit the firm that developed it, but may also boost countries' overall productivity. Therefore, it is essential for the government to fund these activities, because corporates will only take the risk when the returns are higher. But not all of this research and development is only beneficial for them, it is beneficial for everyone. So sometimes the government needs to step further and boost the private sector by giving them more incentives. The effect of social returns on externalities are captured in endogenous model. We discussed that, which concludes that economies may not reach a steady state of growth, but may permanently increase. Isn't it? That's the benefit, correct? When external benefits to the economy of investing in R&D are not considered, many possible R&D projects do not have returns enough to compensate the risk. As I said, when we do not consider the external benefit, right? When I'm doing R&D in some like field of medical or science or technology, right? They are not always commercially profitable, but they are done for the betterment of the entire nation or the country overall. And therefore, the government is needed to step up here and boost the, by providing some tax breaks or credit in form of incentives, right? From an aggregate economy-wide point of view, the resultant level of R&D investment will be suboptimal or too low if there is no support from the government, and therefore government needs to subsidize R&D so that private can spend more on that and bring the economic growth for the nation. So government incentives are very essential, because if the privates, if they are left to the private, they will not be, they'll be hesitant to take more risk rather. Why? Because not all of the research is successful. And if there are no incentives to do so, economies will not do the research. They will stay away from it because it's not providing enough returns, isn't it? So all the government should have enough of incentives for research and development, right? Correct? Yes. Now we are going to talk about trade barriers. Now, of course, we know for economic growth, the trade barriers should be as low as possible, right? Correct, correct. So removing trade barriers and allowing free flow of capital definitely benefit the countries, isn't it? There's no discussion needed here, correct? Right? Increasing in what will the trade barriers, by removing trade barriers, what will happen? Everyone, right? Foreign savings will increase, investments will increase due to foreign capital coming in easily, right? Focus on industries where country has a comparative advantage, economies of scale, investments in technology, and they have said increased competition leading to failure of inefficient firms. Yes, those companies which cannot compete these high tech foreign firms, they will get wiped off. So only efficient will survive. Overall, even before I read the neoclassical model or the endogenous model or the club convergence, whatever I read, remember that removing trade barriers always increases the economic growth. Okay. Under the neoclassical model, predictions in an open economy focuses on convergence. Since developed economies have not reached this point, now remember, developed economies still has enough to grow from capital deepening, isn't it? So they do require foreign investment. So we cannot have the foreign investment stopped. So under the neoclassical theory, the developed economies more need the capital, and therefore these economies will develop if there are no trade barriers. Why? Because we need to allow the foreign capital or foreign investment to come in. Clear? So neoclassical believes that developing economies need more of the capital, and therefore there should not be trade barriers or even the barriers in capital. Capital should be freely convertible, means capital should be easily allowed so that that capital can invest in technology, right? On the other hand, endogenous theory predicts greater growth with free trade and high mobility of capital, since open market foster increased innovation. Remember, endogenous theory says that any investment in capital which will eventually go to technology, and that will have a permanent increase in the growth rate. So they do support this part that yes, having less trade barriers or capital barriers will definitely increase the economy, and that will have a permanent effect. Also, economies of scale increase the output as the firms serve larger markets. Yes, that is also true. So they also support the same view. But remember convergence theory, where the underdeveloped will eventually meet the developed nations, right? In terms of convergence, removing trade barriers on capital and trade may speed the convergence of standard of living of the poor nations, right? Or the less developed nations. They don't use the word poor because they feel it's going to be offensive. So they use the word less developed. Okay. Remember in the childhood, we learned this term called developing countries. So some countries are still developing. Now, to make it fancy, they use a word called emerging countries. Okay. Research have shown that as long as countries follow outward oriented policies of integrating their industries with world economy, increasing exports and that standard of living converge to the developed. Basically, removing trade barriers, making your country more open for foreign trade will improve the standard of living. No doubt in this, isn't it? Correct? Countries following inward oriented policies and protecting domestic industries can expect slower GDP growth rate, and convergence may never happen, like North Korea. Autarky. Autarky, remember? In geopolitics, autarky, hegemony, bilateralism, all that we discussed. So autarky is like North Korea, not allowing foreign capital. Today, no country says no to foreign capital. Understood? So let us do the discussion. Which of the following most accurately description of club convergence? Remember, club is that like a US or a Western club where those are members of club, they will grow faster. Less developed countries will converge to the living standards of other less developed, not necessarily until and unless they are a part of the club, isn't it? More developed countries may see their standard of living drop due to competition. No, we didn't study like that. Some less developed countries may converge to the developed countries' living of standards, while others not. Yes, only selected countries who are a part of the club. Isn't it? Everyone understood? See, most of the time the name itself will give you the hint. Okay, next they are saying Sangani statement number 1 and Sangani statement number 2, whether they are correct or incorrect. Jignesh Sangani, okay, seems like a guy from my neighborhood, is an economist with a large asset management firm, makes the following statements about the removal of barriers to trade and capital. Okay, so we have to see whether the statements are correct or not. First, we are going to talk about statement number 1. Removal of barrier is likely to lead to permanently high growth, but under which theory? Not neoclassical. It is under which theory, guys? This is only permanent. Whenever I see the permanent, it is only under endogenous, isn't it? Correct, 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 correct. Yes. So is statement number 1 correct or incorrect? Well, it is incorrect. But due to what? Due to economic growth being permanent or due to economic growth being global? Can you tell me? First of all, it is incorrect. Why? Because it's not as per the neoclassical, it is as per the endogenous. So which one is the incorrect, right? The correct, incorrect? Which one is the incorrect one? Correct, incorrect. B or C, everyone in the class. It's due to B, right? Because of the word permanent. That's not with neoclassical, that's with endogenous. Clear, clear, right? Everyone B, B. Okay. Now, statement number 2, whether it is correct or not, first we'll see that. Okay. Removal of barriers is likely to lead to a permanent higher economic growth for developing countries only under the endogenous. Now, under the endogenous, I agree. But did we study only for developing? No, endogenous says that it is for all. Developing as well as developed. Technological progress will increase the growth for all, isn't it? So it is incorrect due to economic growth being permanent. No, that is true with endogenous. Due to economic growth being limited to developing countries only. Yes, that is the incorrect one, isn't it? See, everyone? Clear? Clear? Agree, everyone? Which of the following is least likely to be associated with the law of diminishing returns? Least likely, least likely. Labor capital or investment in knowledge capital does not have diminishing marginal returns, diminishing returns. In fact, the book that I've published, recently I published my level 1 fast track book. In that book, I have in the preface I've written that knowledge does not have diminishing marginal utility, does not depreciate. So investment in knowledge or education has no depreciation, right? So which one has low diminishing returns or least likely to have least likely against basically the law of diminishing returns? Which of the following is least likely to be associated with law of diminishing returns? Everyone in the class, investment is in knowledge capital. So whatever investments you've done in your CFA level 2 coaching or training with me, that does not have the law of diminishing returns. Okay. So whatever investments you do now or in the future, all of that does not have a law of diminishing returns. Clear, 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 everyone? Right? This is the end of economic growth and end of your economics. I've put all the formulas. So if you carefully see, we have covered various aspects in this. We understood the different preconditions for growth. We did the Grinold-Kroner model to understand the expected return on equity based on the economic growth. And then we understood various forms of economic growth, functions of economic growth, potential GDP, total GDP, change in the GDP. And then we understood how natural resources, labor, physical capital or human capital, development in technology, infrastructure, all of that, how that has an effect on the economic growth. Plus, we also understood different theories, the classical, the neoclassical, endogenous theory, right? And then we understood the convergence theories, absolute convergence, conditional, and club. All of these helps us understand how the economic growth will play in terms of per capita GDP for developing or as well as developed nations, right? And finally, we understood why the government should remove the trade barriers or provide incentives in R&D to boost the economy. Okay, right? That's the end of your economic growth. Any questions? Anyone? Anything? If yes, let me know. Now, from the exam point of view, I'll just tell you one thing that, of course, the weightage of economics is less. Okay. Majority of the questions are going to be from the currency topic. Although I have discussed each and every component here, right? But the objective is to cover everything. However, not everything is exam oriented. But since you're doing the first reading, you should read everything. When you proceed towards the revision, it won't take the same time. It will rather take less time. Okay. But when you're doing the first reading, cover everything. Of course, you can do the fast forward of the video. And of course, I'm sure when you'll be watching the video, you'll be watching it at least at 1.5 or 2 to cover up everything. But yes, that will really benefit. Once you should touch upon everything, and then you can cut size when you go to the revision mode. Why? Because see, the CFA institute material is actually much bigger than this, much larger, much wider than this. The Schwezer is, we have cut sized a lot. From this, cutting is very risky. We will do that naturally. When we proceed to revision, we'll cut off, but I'm saying it won't take the same amount of time. Got it? Perfect. Yes. Thank you so much.